I, as a chairman, welcome today's speaker, CA Kamal Garg sir and CA Ramesh sir. I welcome our today's chief guest, MPV sir, past CCM of ICI, and I welcome SARC treasurer and our ex officio Sundarajan sir, and also welcome our ex officio RCM member Rekha ma'am for today's validity session. It is a wonderful coordination by our corporate law committee of Chengalpattu branch for conducting the 3 hours program of continuous education on corporate law. I thank one and all for taking these efforts, and also I thank all the participants who have registered in large numbers and attended on the large numbers and enriched their knowledge on these type of seminars. And I request everyone for the continuous support to the branch. Thank you, one and all. Thank you, ma'am.
Thank you, Chairman. I now invite our beloved MPV sir to render a special address.
Thank you, Geeta. And hearty congratulations to Sri Priya, Chairperson, Corporate Law and Corporate Governance Committee, and all the office bearers of the Chengalpattu branch for having conducted this 5-day program on company law. Company law as a subject has always been an exciting subject, and more so with the changed expectations of all stakeholders, the regulators, investors, and other stakeholders. The law is assuming substantial amount of significance. I'll just share one perspective. I'm sure over the last 5 days, all the speakers, including Mr. Kamal Garg, Ramesh, would have fed you with very high level of knowledge and practical insights on the key topics which they have spoken on. My only observation, and this is what I would like to share from my experience, particularly at ICA in the last 6 years, having worked very closely with the Ministry of Corporate Affairs, is when these regulatory changes are brought in, whether it is on the governance side or relating to financial statements or any other aspect, the first thing we all need to look at it is from the perspective of MCA as to why this particular amendment or a provision has come into force. Once we understand the raison d'etre of why a particular provision has come into existence, then compliance becomes pretty simple, and more importantly, we will not have a negative approach on compliance. For those who have seen the MCA website, they have their mission statement, which they talk about 2 things as the purpose of their existence. One is protecting investors. Second is empowering business. Protecting investors. Second is empowering business. And if you look at almost all of the changes which keep coming in, they will fit into either of these. And more so, if you look at the topics which you have deliberated in the last 5 days, whether it is changes surrounding Schedule 3 or CARO or CSR, all of these changes are based on the experience of MCA in the implementation of the New Companies Act, more particularly after the Insolvency and the Bankruptcy Code came into existence. We are all witness to the fact that in the IBC, almost all the cases, banks had to take a haircut of 70 to 80%. Not a small number. It's not a number we can be proud of. It's a substantial number where banks have actually taken that kind of haircut. And that haircut is nothing but loss of public money. It's public money which has been lost. All of those bad debts are not a loss absorbed by the shareholders of the bank. They are the losses which are actually borne by the depositors of the various banks in the form of taking a lower rate of interest. So effectively, the spread between the lending rate and the cost of running the bank operations, bad debts margin, the net number is the amount which actually is paid to the depositors. So if these NPAs were lesser, probably the depositors would have got another 30 basis points or 50 basis points higher interest amount, which is a substantial money. That is one experience. The second is, look at almost all the IBC cases. The annual reports or the audit reports were signed by the auditors and the financial statements by the directors in the month of August 2018, August 2019, and all of them have signed financial statements on the basis of going concern. But within 3 months, October, November, December, those entities have gone bankrupt. So what was signed off as solvent, within few months, they have been signed off as bankrupt, which means there weren't enough red flags which were communicated. So based on that experience and the need to protect investors, some of these substantial changes have taken place, be it Schedule 3 or CARO, which in my view is a single piece of amendment. Second is on CSR. Similarly, the experience has been that there has been fair amount of money laundering happening on that, in the sense that these monies were not being spent for the purpose for which the law envisaged, and there wasn't the desired outcome coming. So people were claiming to do CSR, but the outcome was not visible. So government had to step in and increase the quantum of regulations around CSR. And please note, it's not going to stop here. Most likely within a year or two, audits of CSR spend, independent audits of CSR spend, both financial and outcome-based audit, has the planned outcome been achieved, is likely to become mandatory, at least for CSR spends beyond the threshold, probably CSR above 5 crore, 10 crore, whatever limit. But it is quite likely because there is enough evidence that it is not meeting the desired objective. So that's the other point. So my 2 cents to all the stakeholders here, both in terms of our compliances with the Companies Act requirement and influencing the companies where we are engaged with in terms of good corporate behavior. If we want simpler legislations, if we want much more ease of doing business, there is a heightened need for increasing levels of governance, particularly self-governance. All of us are champions of governance changes, and I would request all of you to participate in the Institute's efforts in this direction. So thanks to all of you patient listening, and thanks to all the speakers who have given their time for this 5-day sessions, and thanks to the Chengalpet branch and Priya for the perseverance in following through with me for this opportunity to interact with all of you. So apologies that I need to participate in another technical session here at Madurai. So with your permission, I'll log off within a minute. Thank you all.
Thank you. Thank you very much, MPV sir, for your wonderful brief address. Thank you so much. In spite of your busy schedule, you are able to join us because of the love and affection you are showing towards Chengalpattu branch. Thank you so much once again on behalf of the branch. Now I invite our ex officio, RCM and SARC Treasurer, C.A. Sundararajan sir, to render a brief valedictory address. Please unmute yourself, sir.
Respected Chairman of the branch and his team, who have beautifully organized this program, and they've been consistently following with everyone and getting it done. And Geeta Madam, past Chairman of the branch, she's been a backbone of this program. And the past Central Council member MPV sir, who just left, and past Chairman of SIRC Dungarjan Jain, who had been in the screen for some time. And present Central Council member CPE Madam, who have done so much of help to the branch and this program also, in arranging the speakers and other things. And the respected speakers of the day, Kamal Garg sir, Ramesh sir, namaskaram to all of you. And with the participants, the number is slowly increasing now. The program, when we started, it was less, but now it is increasing, and it is very encouraging. As our chairman said, even during his installation program, I said the same thing. We need more participants. Our branch has got so much of strength, so we need more participants. We were able to increase the strength based on the jurisdiction in the records of the ICI, but we should increase our strength by participating also, so that we'll be able to get better knowledge. The knowledge is distributed to all of them, and our branch name. See, we all feel that it is our branch. So people used to say that you have become now a regional council member, you cannot call it as your branch. But still, I get only that mind in my that mind has been set in my thing. So I'm not able to call. I'm able to call only as our branch. So the support we can get from the regional council also we are getting. And the previous program, which has been conducted beautifully by our branch, along with the Pondicherry branch, has been talk of the town now. So everything is going on the right direction, and with the positive notes. We need to reach the members. Chairman sir, we need to have a program to reach the members.
Yes, sir.
Not for this articleship alone, but for other programs and participation, everything we require. So that will be the keynote of mine today. So because we need to reach them. If we have not communicated to them that the branches with this strength and with this infra, it is going on well. That needs to be communicated to the members of this branch, and so that they can also participate, and also the members of the industries. And regarding this program, this has been beautifully organized by our branch with the lead from Geeta Madam and Priya, our MC member, with the support of all the MC members, I should say. Even the CPE committee chairman is also there. So everybody has cooperated so well, and you have all got the best speakers. And thanks, we should say thanks to Sripriya Madam. Yes, it has all happened. So I'm very happy about the progress in the branch, and also the topics what they have selected is also very fine for us to know more. And thank you all for inviting me to be in the program. I think I don't want to take much of your time, because there are a lot of speakers lined up, and we need to hear more from them. Thank you all. Thanks for your invitation. Thank you, sir. Bye.
Thank you, sir. Thank you for your encouraging words and the brief address. Thank you. We'll continue to be more and more active and dynamic in the future also, sir, with all your support and blessings.
Definitely.
Thank you. Now, I invite our RCM and ex officio member, CA Rekha Pillai, to render a brief address.
Good afternoon, ma'am. Thank you for inviting me to this session. Am I audible?
Yes, you are.
Yes.
Am I audible?
Yes, ma, you are audible.
Yes, audible.
Yeah. Thank you. So, Yeah. Let me invite all the members who have registered for the session on the 5-day virtual workshop on corporate laws. So firstly, thank you Satyanarayanan sir, Priya ma'am for inviting me, Geeta Kumar ma'am, my guide and my mentor and my fellow council member Soundarajan sir, my guru who has just left the meeting, MPV sir. So and Ramesh sir, we recently met at Vellore. So I think before I tell about the session, I think I should be congratulating Priya ma'am under the guidance of Sri Priya ma'am, the Vice Chairman Corporate Law Committee. She has actually arranged a very beautiful 5-day virtual workshop along with our CP Chairman Yuvamurthy sir and all the other MC members. I think one thing I have to tell about is with respect to the topics. All the topics are very meticulously cherry picked, the one which are very relevant for the current days, especially those who are in practice. And neither I don't have to say about the faculties. We have two superb faculties here, very fabulous speakers. Kamal Garg sir. Sir, as I already told you, I was a little unfortunate for not being a student, but I'm really very fortunate to attend your session today. Then we have Ramesh sir. I don't think any person out here would have not attended the bank audit sessions of Ramesh sir. He is such a fabulous speaker again on the topic. And all the topics, whatever we see, especially we had the CARO amendments, we had the Schedule 3 amendments coming into picture. So many new clauses that has been added, whether it be the willful defaulter clause, whether it be relating to the Binami transactions, whistleblower mechanism, very wonderful clauses that has been incorporated where the auditor has to actually make sure these areas has to be audited and reported carefully. So there is an additional responsibility and safeguard that has to be taken from the side of auditor. And I think Kamalga sir would be the best person to, I think he can be called as the audit guru, especially if you see the final students. He's the audit guru for almost all of us. So I think he's the best person to address the gathering on this. Once again, I welcome you, sir, Kamalga sir, and Ramesh sir for this session, and all the members who have registered for the session, and also Priya ma'am. A special congratulations to you and the entire team for wonderfully coordinating the program. Thank you so much.
Thank you. Thank you.
Geeta madam. Hello.
Yeah, ma'am.
Chairman sir,
Priya?
you were able to hear?
Yeah.
Yes, sir. Yes, sir. Priya,
Yes, sir. Madam, Rekha madam, when I was speaking, I was not able to, I have not mentioned your name, but I told you earlier before the meeting started. Sorry for that. I welcome you also. Thank you.
No issues at all, sir.
Priya, you continue, please.
Yeah.
On behalf of Chengalpattu branch, we thank CA Sri Priya, Central Council member, Chennai Corporate Law Committee of Delhi, and all the members, MC members, and all the members of the branch who have been there throughout us all these days with large numbers and have been supporting every day in our program. Friends, knowledge is like a garden. If it is not cultivated, it will not get harvested. We at Chengalpattu branch are in continuous efforts on regular basis to harvest this knowledge through eminent speakers and dissemination of their knowledge. So we move on to this technical session of the day. Today we have with us CA Kamal Garg from Delhi to talk on the topic on recent regulatory mechanisms by ROC, penalties and late fees in MCA e-governance. I welcome our Corporate Law Committee Chairperson, Shri Yuvamurthy, to please introduce the speaker.
Yuvamurthy ji, I have a small request before you give any profiling or so. Maximum 2 lines, nothing more than that.
Sir, you are the best.
I think so. You don't want introduction itself, so actually. You are the...
that is so kind of you, but I want that and I should not be introduced.
Right.
Okay, so only maximum 2 lines just to have the formalities.
My pleasure to introduce on
behalf introduce him as a most beautiful person, sir.
That is a nicest introduction I got anytime.
Everybody knows you, yeah.
Yes, you are.
Right, sir.
Magic of Fair and Lovely.
Yeah, sir. Thank you, ma'am. Thanks to the Chengalpattu branch of SARC of ICI for this opportunity to give an introduction about our eminent speaker, CA Kamal Garg, sir. First of all, we welcome you, sir. CA Kamal Garse is a fellow member of ICAI and first class bachelorate from the Deen Dayal Udayappa College, University of Delhi, and academic resource partner in KGMA, Delhi. He has a qualified in DISA conducted by ICAI and IP insolvency professional with Insolvency and Bankruptcy Board of India. He was a board member of Board of Studies, and he has been various board members in accounting standards boards, implementing that is implementation in India's implementation committee of ICA. He was also nominated as a special invitee members to the Committee on Banking, Insurance and Pension of NARC ICI, and he is also a faculty resource of the peer review board of ICI. Besides being a regular guest speaker of IFRS and Management Development Program at various forums, including ICA and ICSI, he is also an author of over dozens of books and commentary on introduction, including IFRS and Ind AS concept and application. COVID-19 Guide to Financial Reporting and Audit, COVID-19 Guide for Business and Professional, Conscience, Commentary on Companies Act, Companies Resolution, Notice, Meetings and Minutes, Borrowings, Loans and Investment by the Companies Law, Accounting and Taxation, NFRA, Law and Practice, Ind AS, a ready reckoner, Standards on Auditing, a practitioner guidance, a concise commentary on the Insolvency and Bankruptcy Code 2016, series of books of Companies Act 2013, and Corporate Social Responsibility, Guide to the Tax Audit under Section 44AB, CARO 2016 and CARO 2020, FDI in India, and Audit Practice Manual, and book on Companies Balance Sheet and Profit and Loss Account under Schedule 3, and book on Internal Audit, Consolidation Financial Statement, Interim Financial Reporting, Guide to the International Taxation, Understanding Goods and Service Tax, Corporate and Allied Law, including Insolvency and Bankruptcy Code, Insolvency and Bankruptcy Code, a ready reckoner, Professional Approach to the Auditing for the CA firms, and a systematic approach to the auditing for CA studies published by leading publishers House Walter House Private Limited. And he has to credit the contribution of Gist of Accounting Standards and Accounting, Auditing and Assurance Standards for Volume 2 of the Companies Law published by the BL, and various articles for NARC and the CARC of ICA, newsletter of FBT, MAT, US SOX, CARO, FEMA, etc., and a series of articles, Delhi Value Added Tax, including various articles on the external commercial borrowing, direct tax, and foreign investment for TCR. He possesses a rich industry experience in areas of corporate law. Now I welcome you, sir, for this wonderful gathering, and now I request you to take over the dais. Thank you, sir. I think it's a introduction.
Okay, I believe I have no words to say thank you even, because you have introduced me so much that I'm out of words. So the topic given to me is regulatory mechanism. I need to have a mechanism to regulate the introduction now.
Mr. Kamalgar, I think
Yes,
we in Chennai love you so much that we can't resist but introduce you.
That is true. But I feel so humbled, sir, by this introduction. And it's your love and affection. And I must say, Chennai had been second home to me because I started my career from Chennai. So if I go back to year 2002, so I kicked off my career from Chennai. So Chennai has given me much, and a lot more I am getting is nothing but love and affection. I acknowledge the presence of so many friends I can see on screen. So Chennai is very kind to me, and that's why I'm humbled more, because Yuva Murthy gave my introduction, and I can see Priya ma'am, and I acknowledge the presence of my friend Arunji, Gita ma'am. So always they took good care of me. So whenever I came Chennai, I never felt I'm out of my house. Anyway, so good afternoon to each one of you listening me. Before I share my PPT, I have a small question. And I would request don't search and Google the answers for these questions. Question number one is, I was told in past 4 days, you had been discussed with the topic of CARO, Schedule 3, corporate governance. Can you give me any 2 or 3 examples of ROC activism vis-a-vis the financial statements? I repeat my question. Can you give me any example of ROC activism or ROC's monitoring scenarios over financial statements whereby ROC levied a penalty or had launched any kind of prosecution against the company? An example. Think from Schedule 3 point of view. And if not Schedule 3, maybe you can think from the point of view Schedule 6 in past. Any answer?
Related party.
One is party related transaction. Any other thing?
The non-compliance of Schedule 3 itself.
Yes, non-compliance of Schedule 3. Now, why I ask this question, there is a reason. Schedule 3 is amended But we cannot say that Schedule 3 was never there. In past, we were having Schedule 6, then it became revised Schedule 6, then came the New Companies Act, Schedule 3, then it had been amended in 2018 and recently in March last year as well. ROC had been active since ages. I will show on the screen also. Like ROC sending notices under Section 129 of Companies Act regarding financial statements in Schedule 3. ROC sending notices for poor drafting of your director's report. Like for example, you can take a note of this section also, Section 134 of Companies Act. Now in Section 134 of Companies Act, the directors are required to report about related party transactions. Now these transactions are envisaged by Section 188. So if this disclosure is not there in director's report, but notes to account says that we were having RPTs. So on one place you are having RPTs in notes to accounts, but director report is silent. That means if director report is silent about RPTs, it is a deficient director report. And for that deficiency, ROC has a practice of sending notices. I'm not saying that notice was good or bad, or notice is defendable or not. But the fact is, ROC deep dives into whatever you're filing to MCA portal. So please be under no misconception. Please be under no misconception that whatever ROC notices are coming or are bound to come, they are feeble notices or they are weak notices, and we will defend in the court or maybe the NCLT. That could be the second part of the theory. But the fact is, ROC deep dives. ROC is taking cognizance of whatever you're filing to the MCA portal. It could be audit report, it could be Schedule 3 statements, it could be MGT 14, many such things. We'll discuss that thing. And that is the reason I found this topic is a very apt topic, regulatory mechanism. Most of the chartered accountants, somehow, when they practice Companies Act, they go more into filing. I agree, they go more into filing. Let me ask you one question. In most of the ROC forms, at the end of the form, certification from professional is required. And when this certification from professional is required, the very first paragraph uses the very first sentence, I am being engaged. How many of you people are taking engagement letter? It had been a customary practice that professionals are certifying. Now imagine a situation, Priya madam is ROC and you are a chartered accountant who attested one of the T form. Priya madam can issue a show cause notice to you that why a penalty upon it should not be levied for wrong certification. And at that very time, the very first defense which ROC will be taking to be used against you. I am saying defense for a reason that I will discuss in the clip, will be, keep Mr. Chartered Accountant, please show me the engagement letter. And you would not be having that engagement letter. It will result not only a contravention under Companies Act, but also a contravention under Chartered Accountants Act. So we need to be specific about that thing. So my discussion will be, the first part of my discussion will be regulatory mechanism. The second part of my discussion will be fines and late filing fees. Without searching on Google, can any one of you please tell me, is there a difference between fine and penalty? But please don't search on Google. Google will give you immediate answer, and I want you people to think. Is there a difference between fine and penalty? You must be aware, of late, Companies Act was amended in 2020 and various effective dates were given. Most of the places, the words were substituted with the words penalties. So is there any specific reason for a difference between fine and penalty? Any answer from any one of you? So we need to understand the difference between fine and penalty also. I will be sharing my screen and I would request you people, whatever critical points I am going to tell you, please take a note of those points in your notepad, because almost each thing may not be on PPT. PPT may have provisions, but not the commentaries as such. So with your permission, ma'am, I am sharing the screen.
Yes, sir.
Please confirm me once my screen is visible.
Okay.
Are you able to see my screen, ma'am?
Yes, sir.
Okay. So this is my topic, recent regulatory mechanisms by ROC, penalties and late fees in MCA e-governance. So to begin with, let me show you certain instances in past. And these instances will guide you to understand how far ROC is active nowadays. Please understand, whatever things I will be showing you will show you how far ROC is active. I am nowhere discussing whether ROC was right or wrong. I'm simply saying that ROC was active in these mechanisms. Just see one by one. See, the matter was regarding recording of minutes. ROC issued a show cause notice. However, ROC lost the case. The matter was Usha Martin Telematics Limited versus ROC. Calcutta High Court delivered a judgment. And what was the judgment? Typographical or inadvertent errors. Typographical or inadvertent errors in recording of minutes, which is rectified subsequently, cannot be termed as an offense, far less an offense under provisions of Companies Act. You must be aware, by virtue of Section 118, tampering of minutes is an offense. But in this case, what happened? The company was able to establish that it was not tampering, it was a typographical or inadvertent error. So ROC was saying that it is tampering, but company maintained the status that it is not tampering, it was an advertent error. So matter went up to the High Court, and Calcutta High Court stated that this is not an offense. But what you need to understand from this very judgment, the judgment is of no use at present in my topic at least, but yes, this judgment is giving you the indication. The indication is that ROC is active. ROC is taking the cognizance of certain facts. One of the fact here is recording of minutes. Now, please consider my statement. You must be aware the ground reality is different. The ground reality is maybe most of the private companies are not maintaining minute books. By virtue of Section 206, 207, 208 of Companies Act, ROC is having the powers to inquire. And one of the inquiry could be whether you are maintaining proper books or not, proper minute books or not. Say, you stated that we are maintaining minute books. If you refer various e-forms, you are uploading resolutions also. You are uploading resolutions, but perhaps those resolutions are not even recorded in the minute books. So out of inquiry, inspection will take place. And out of inspection, if it is unearthed that there was no minute book, who will be responsible? Not only the company will be responsible, but also the company's officers will be responsible. But also the professional who certified various e-forms will also be responsible. And that is why we professionals need to understand the implications when penalties are levied or leviable. So I will be teaching you in this very scenario the concept of court, how far court is involved vis-a-vis we people as professionals. We will come to that. Let us take one more instance, Madras High Court judgment. Very recent judgment. If my memory serves me right, this judgment came last year only. The case name is Deva Jaya Thanga Tambi case. So what happened in this case? ROC was going through the notes to counts. And in notes to counts, the ROC never found any kind of detailed information about the bad debts provided by the company. He issued a show cause notice. And after show cause notice was issued, whatever reply he received, ROC stated that reply which I am getting are not satisfactory. So ROC stated because replies are not satisfactory, the company is guilty of offense under Section 448. Section 448 of Companies Act deals with suppression of facts. So matter again went up to the High Court, Madras High Court, and just see what happened in that very judgment. Madras High Court held that wherein the P&L account of petitioner company for the year 2011, a sum of rupees so and so was shown as bad debts written off, and though there was no finding as to showing suppression of material facts by the petitioner, inspecting officer means ROC's officers, filed a complaint under Section 448 against petitioner only on the ground that reply to show cause notice given by the petitioner was not satisfactory, and hence the prosecution should be initiated. But what the High Court stated, that if the prosecution is going to be initiated, it will be taken as abuse of process of law, because a mere unsatisfactory reply to the show cause notice cannot be considered as suppression of fact. Again, the same thing I will repeat. The matter here is not about whether ROC was feeble or not, ROC was weak or not. The matter is ROC deep dived. And when ROC deep dived, he initiated some proceedings. And these proceedings are nothing but ROC activism. And that is the topic is. The topic is recent regulatory mechanism. So one of the mechanism which ROC invoked here is nothing but Section 448 mechanism. One more example. Parveen Agarwal case, again by Madras High Court. What happened here? One of the individual was found director in more than 20 companies. So complaint was filed. The matter again approached to the High Court. And just see what ROC delivered. Sorry, what Madras High Court delivered. Where ROC had filed a complaint before the competent court. So we need to understand what is competent court meaning. I will come to the meaning of competent court in some moments. Where ROC had filed a complaint before competent court against petitioner. Petitioner here is the director, alleging violation of section number 165. Section 165 deals with maximum number of companies in which an individual can be director, and the cap is 20 companies. On the ground that he was a director of more than 20 companies, and the said complaint was filed without considering the fact that petitioner had already filed an application for compounding of alleged offense. Complaint filed by registrar was not sustainable and was to be quashed. Are you getting this point? So in this case, what happened? Nobody denied that director was wrong. But only thing is, multiplicity of proceedings were going on. Already compounding application was pending, and still ROC was taking the action. So Madras High Court stated that two things cannot go hand in hand. Compounding application is already pending. So what you need to do, you need to wait for the judgment, because once the compounding is allowed, automatically the director will be sin-free. So again, the same thing we need to take note about is ROC is active. So please be under no misconception that nobody notices you. Government as regulator through ROC is noticing each and everything which is in their domain. One more thing. Again, the Madras High Court judgment, Khivraj Motors Private Limited case. So what happened in this case? If you remember, in the old Companies Act, we were having section 205 capital C. In the old Companies Act, we were having section 205 capital C and section 205 capital C, which today is section 123. It stated that dividend can be declared out of profits and dividend has to be paid only in cash. So non-cash settlement of dividend is not allowed. Now what happened here? Some contravention of old section 205C regarding declaration of dividend took place. ROC issued a show cause notice, but show cause notice was poorly drafted. ROC simply reproduced the section 205 capital C, and the notice was issued by this very virtue only. Again, the matter went up to High Court, and what Madras High Court delivered? Madras High Court stated that show cause notice must be specific as to exact offense for which the company is prosecuted. Merely reproducing the section in show cause notice will not help you. So this is a kind of defense also for us as professionals. Whatever notice we are getting from ROC, we have to first check whether that notice is defective or not. And notice will be deemed as defective if that notice is silent as to the specific observations of ROC. So if the notice is having reproduction of the language of section, that notice will be merely a defective notice. Similarly, some more points of ROC activism. It may happen that a resolution was required to be passed as special resolution, but somehow you put up minutes as special ordinary resolution. Is it an offense? Primarily, it could be taken as an offense. But if the intention is bona fide, then it is not a kind of offense. And the matter went up to NCLT New Delhi. Let's see what happened in Economy Hotels India Services Private Limited case, where the appellant company had placed on record sufficient documents to prove, I emphasize the word prove. Prove means the intention, to prove that there were a special resolution, though referred as unanimous ordinary resolution, as required under section 66, as well as in terms of article 9 of Articles of Association of the company for reduction of share capital. Reduction of share capital was to be confirmed. So ROC was saying that your resolution says unanimous ordinary resolution, but special resolution was required. So I will not allow reduction of share capital. I objected. NCLT said, no, you cannot reject because there was a bona fide error or inadvertent error. The intention was clear and hence it was allowed that capital can be reduced. Similarly, you must be aware a subsidiary company cannot hold shares in holding company. This is the provision given in section number 19. A subsidiary company cannot hold shares in parent company. That is the provision given in section number 19. But what happened in this case? This offense took place. So the matter went up to NCLT Kochi. In Doha Brokerage and Financial Services Limited, what NCLT Kochi held, where petitioner sought compounding of offense punishable under section 450. So section 450 is a residuary penalty clause. Where no penalty is prescribed, you have to levy penalty under section number 450. We will discuss in detail at a certain stage. what it stated, wherein petitioner company allotted equity shares to its subsidiary company in violation of Section 19. Section 19 says a subsidiary company cannot hold shares in parent company. Each officer in default as members of the board of directors was to be subjected to a fine of rupees 5,000 as a deterrent for not repeating default in future, and offense was ordered to be compounded subject to remittance of compounding this impost. So again, I will repeat same thing. The action was taken by ROC. So ROC is active to that much of extent. Now, one matter for right issue. Madras High Court again in Vikramjit Singh Oberoi case, where company allotted shares on right basis to its existing shareholders merely because many of them renounced their entitlement in favor of more than 50 third parties. It could not be said that right issue was converted into public issue. So this is the old judgment. At present, this limit is 200. And this I discussed in the very beginning. Section 134 Director's Report. In the same case, Vikram Singh Oberoi case, Madras High Court also stated where company had availed services such as car rentals, laundry services, etc. from party related, and it had not disclosed same in the board of directors report. Since these transactions were in ordinary course of business on ALP, ALP means arm's length pricing basis, section 134 would not apply. So what is the meaning thereby? In notes to accounts, the company has disclosed certain RP transactions. Now these RP transactions may be in ordinary course of business, may be in abnormal course of business. If it is a normal course of business, then you have to disclose these transactions even in director report. If you will not disclose, it will be contravention of section 134 and ROC may take suitable action against you. So these are certain examples just to limelight how far ROC is getting active at present. So you cannot shy away of your responsibilities by merely attesting the form. You have to be critical enough and diligent enough and vigilant enough when you certify any form. So this is the basic setting the tone scenario. Now let us deep dive into provisions. First question to the house. In most of these cases, you must have seen the word court is used. Now my problem in this whole discussion is, can you please tell me whether ROC is aggrieved party or not? So if you're filing a wrong form or if you're tampering the minutes, who is taking action against you? ROC? Whether ROC is an aggrieved person?
No, sir.
So the answer is no. But I'm not saying it is the correct answer. See, why I'm asking this question? If a case is approaching to any forum, NCLT or NCLT or the court, one will be the plaintiff, one will be defendant. We can always comfortably say that when ROC issued the notice to a company, company will become defendant. But who is the plaintiff? Plaintiff is ROC. So whether this ROC being plaintiff can be called as aggrieved person? Answer is yes. I will show you how. And here is the reason we have to refer to CRPC, Criminal Procedure Code, specifically for those very issues where fine and imprisonment is involved. So ROC is aggrieved person, section 469 CRPC. I will tell you in detail in some moments. So with this background, let us have the deep dive. I asked you a question, distinction between fine and penalty. So you can take a note of this thing. Fine and imprisonment can be imposed only by competent court. We will understand what is the meaning of competent court in some moments. However, in certain cases, adjudicating officers, which in mostly cases we have ROC, has been authorized to impose penalties. So what is the distinction? Penalty can be levied by adjudicating officer, whereas fine and imprisonment, as the case may be, can be imposed only by the competent court. And as far as competent court is concerned, we have section number 2, clause 29 of Companies Act, read with section 435 of Companies Act, which will define competent court, primarily special courts. Then we have section number 449 regarding a punishment provision. What is the punishment here? The section 449 is punishment for false evidence. So if any person intentionally gives false evidence or gives false affidavit, he shall be punishable with imprisonment for a term which may extend to 7 years, but minimum 3 years, and shall also be liable to fine up to rupees 10 lakhs, section 449. To take an example, you are submitting a form. In that very form, you are giving a false resolution. So false resolution is nothing but the false evidence. And that false evidence may result in this kind of punishment as envisaged by section number 449. Having said that, please tell me whether section 449 punishment, can be launched by ROC. And second question is, if you say yes, it can be launched by ROC, can this punishment be given by ROC? Yes, any answer?
Sir, I am not getting your question, sir.
I write my question on the screen. Let me write the question on screen. My question is, sir, whether punishment under section 449 can be launched by ROC. And number second question is, sir, who will give punishment under section 449? These are two questions, sir. Any
It
answer?
can be launched by ROC, sir.
It can be launched by ROC. Okay. And what about who will give this punishment?
That I am doubtful, sir.
Just see, answer is on the screen itself. Ask yourself, what is the nature of punishment in section 449? Is it penalty or fine / imprisonment? Can you see there is no word penalty used in section 449?
Yes, sir.
Anna, so what will happen because section 449? So let me write here only. The answer here is yes. But how he will launch, I'm not telling you now. I will tell you in certain moments. Now, who will give this punishment? Competent court. Why? What is the answer? Answer is because section 449 deals with fine and imprisonment. Am I clear? So we professionals need to be very particular to understand the jurisdiction. So say, for instance, ROC issues a show cause notice to you under section 449. That notice itself is defective in a way because the proper notice shall come from court only. Because ROC has no powers. ROC has no powers to levy fine and imprisonment. Now, let me come to the second scenario. Section number 450. I told you, for any contravention for which there is no penalty prescribed, no fine prescribed, no penalty prescribed, sorry. Then we will go to section number 450, general penalty clause. Just see how the words are drafted here. Residual penalty for contravention of provisions of company law. What the section says, where no specific punishment or penalty has been prescribed in this section for the contravention of any provision, the person is liable to penalty of rupees 10,000. In addition, in case of continuing offense, please keep these words continuing offense in mind, because I will be asking some questions here. In case of continuing offense, there will be penalty of rupees 1,000 for each day after the first, during which the contravention continues, subject to a maximum of rupees 2 lakhs in case of the company and rupees 50,000 in case of officer who is in default or any other person. Now, please tell me the same question. We can again start. Whether punishment under section 450 can be launched by ROC. And second question is, who will give the punishment under section number 450? Yes, any answer? You can see the section once again. Ask yourself whether punishment under section 450 is a penalty provision or a fine and imprisonment provision.
Yes, sir.
Yes means?
Hello, yes, sir.
Yes, sir means again, what should I put as a further answer? Yes means my questions are correct, or yes means your answer is correct?
Punishment under 450 can be launched by ROC.
Okay, it can be launched by ROC. Okay, taken. And who will give this punishment?
ROC.
This will be ROC. Why?
Because it's a penalty provision.
Because
No imprisonment is there.
450 is penalty provision and not fine and imprisonment provision. F&I means fine and imprisonment. Are you getting my point? Understood? So this is the very first basic thing which we need to understand. Penalty versus fine and imprisonment. And you must be aware, if you refer section 441 of Companies Act, section 441, compounding of offenses, the section says, if an offense is punishable with fine and imprisonment, if an offense is punishable with fine and imprisonment, that cannot be compounded. So where you will go? You will go to the competent court. The words used here were containing offense. So we need to understand containing offense also. Let us proceed further. I will skip this clip. I will come to this clip at a later stage when time will permit. Competent court. So the expression competent court need to be taken the interpretation from section number 2, clause number 29. Section number 2, clause number 29 says, the section number 2, clause 29 is of Companies Act only. So I'm not taking this from CRPC or CPC. Section 2, clause 29 of Companies Act says, court means High Court having jurisdiction. If you remember, when I was discussing certain case laws, the judgment was given to Madras High Court. So Madras High Court is nothing but having jurisdiction. Then number 2, district court. In cases where central government has by notification empowered any district court to exercise all or any of the jurisdiction. Number 3, court of session having jurisdiction. Number 4, special court established under section 435 of Companies Act. So in Companies Act, we have a special court. And then any metropolitan magistrate or judicial magistrate of first class having jurisdiction. So what you need to understand, as far as our company law matters are concerned, who will listen these matters? High Court or the district court or the court of session or special court under section 435 of the Act or metropolitan magistrate or judicial magistrate of first class. I'm not going into the distinction between district court and court of session, but yes, as a matter of a very briefing scenario, when I say district court, these district court need to be notified by central government for the purpose of exercising all or any of the jurisdiction meant for the purpose of Companies Act. So depending upon district, we have to see whether any district court is there or not. Like in Delhi, we have Dwarka courts. Dwarka courts are given certain jurisdiction in company law matters. Now, having said that, a small question. I'm keeping this white. Can you please make a distinction between containing offense and non-containing offense? Don't give me the definition as per your heart. Is something defined in the law? And let me emphasize, I use the word law. I'm not saying Companies Act. To make it much more precise, entire Companies Act is silent about the definition of containing offense. So is there any law which defines containing offense? Why this is important, please understand. This question is not a kind of basic question. This is a very technical question. There could be scenarios like if the offense is non-continuing in nature, it may happen that the corresponding show cause notice issued by ROC may be time barred. So we professionals at times commit a mistake also. We will see the show cause notice, we will get a panic attack, and we'll file the reply for that show cause notice without even seeing and observing whether the notice was time barred or not. And please remember, once the notice is replied, in a way you're acknowledging the acceptance of that notice, and then the proceedings may get complicated. I'm not saying that you will lose the case, but yes, your case will become weak at the very inception. And that is the reason we must understand the difference between containing offense and non-containing offense. That is time barred cases, how the time barred cases can be derived upon. So that very purpose, we have to refer CRPC, Criminal Procedure Code. And if you refer CRPC, we have section number 472, section number 468, and section number 469. I will start with section number 472. CRPC means Criminal Procedure Code. Section 472 of CRPC says, the offense continues till the provisions are complied with, and fresh period of limitation begins to run every moment of time during which the offense continues. So each day is giving a fresh lease of life. That is the meaning of the sentence. Hence, question of limitation does not arise till offense continues. Section 472 of CRPC. Don't worry, we will refer some judgments also as far as company law matters are concerned. Now, what is the limitation period? We need to understand. The limitation period is given by section number 468 CRPC. Section 468 CRPC says limitation is 6 months if offense is punishable only with fine. I must recollect, I told you, fine and imprisonment are the domains of court, and that is why we are reading this whole scenario. Limitation is 1 year if the offense is punishable with imprisonment not exceeding 1 year. And thirdly, limitation is 3 years if the offense is punishable with imprisonment exceeding 1 year. So it's a kind of slab scenario. That is the limitation period as per the period of imprisonment involved or the fine involved. Can I say, please correct me if I am wrong, can I say, if there is an offense in which only fine is prescribed, I repeat, can I say that if there is an offense in which only fine is prescribed, but there is no imprisonment prescribed, then limitation period always will be 6 months? Can I say this thing? Yes or no? The answer is on the screen itself. So there is an offense. In that very offense, only fine is prescribed, but no imprisonment is there. Can I say limitation period will last only for 6 months? Answer is yes.
Yes.
Answer is yes, by virtue of first bullet point of section number 468. Now, having said that, we have section 469 also. As to execution, section 469 says the limitation period will commence in this manner. So commencement of period of limitation. Section 469, I have not written section here, but yes, this is section number 469. Section 469 says the period of limitation in relation to an offender. Offender could be company or offender could be officer in default or both. The period of limitation in relation to an offender shall commence, number 1, on the date of offense or where the commission of offense was not known to the person aggrieved. Try to recollect my question, whether ROC can be agreed person. That will be resolved here now. Where the commission of offense was not known to the person aggrieved by the offense or by the police officer. The first day on which such offense comes to the knowledge of such person or any police officer, whichever is earlier. Or number 3, where it is not known by whom the offense is committed. So offender himself is not traceable or is not identifiable. Then where it is not known by whom the offense was committed, the first day on which the identity of offender is known to the person aggrieved by the offense or to the police officer making investigation into the offense, whichever is earlier. So from this whole clip, what we are trying to understand, when the period of limitation will commence. For example, if I come to the 3rd point, you tell me the answer. An offense was committed in tampering of minutes. So minutes were tampered, and that is an offense by virtue of section number 118. But who tampered the minutes was not known. Somebody may say he was the company secretary, somebody may say he was the other person, and that's why the things were getting complicated. So we were having no evidence as to who tampered the minutes. Let us take a situation. On 30th June 2018, ROC, by virtue of the inquiry and inspection, got to know that minutes were tampered. He means the ROC. ROC put all the machineries behind the company to trace out who was the offender. The offender came to limelight by virtue of ROC investigation. Hypothetically, let us assume on 30th July 2019 or maybe 30th July 2020. Can we say because 1 year has elapsed, the limitation period is required to be put to an end and the case is time bound? Answer is no. So the very day ROC will get to know the person who was the real offender, the limitation period will begin, and that limitation period will be 1 year or 3 years as the case may be, depending upon the period of imprisonment involved. Having said that, let me come back to the same question again. If minutes are tampered, who will file a complaint against you before the court? ROC. At least you will not go as a professional. So can I say the same question again? And I need to know the answer from people, whether person agreed will mean ROC under Companies Act. Please remember, whenever you will go to the court for those offenses where fine and imprisonment is involved, please always remember not only Companies Act will go hand in hand, CRPC also will go parallelly. So Companies Act need to be read along with CRPC whenever these kind of things are involved. Having said that, my question still is pending. I wait for your answers. Whether person agreed will include registrar of companies. Logically, what your mind says.
Sir, my answer is no, sir.
Why?
ROC is law enforcing authority, no, sir.
That is why the question is, a person is a law enforcing agency. So can we say the person is aggrieved? Please understand. Person aggrieved and person suffered are two different things. I repeat, person aggrieved and the person suffered are two different things. We can always say, in most of the cases, that the person suffered is also the person aggrieved. But it is not necessity that the person is aggrieved must also be the victim. Are you getting my point? So the words used are person aggrieved and not person suffered. And that is why we have a judgment also.
Okay.
In ROC, this is judgment of Supreme Court. In ROC versus Rashri Sugar case, what the court held, ROC is the person aggrieved within the meaning of section 469 of CRPC, and hence he can file a case within the time limit as specified in section number 468 of CRPC after offense came to his knowledge. Are you getting my point? I believe the things are getting clear. So ROC is also person aggrieved. You can take a note of this thing because it is not in the clip. That person aggrieved should be distinguished from person suffered. Person aggrieved is the broader term. And what CRPC uses is the broader term, that is person aggrieved. So ROC can drag you into the court of law also. Having said that, let us proceed further. I told you that the words used are containing offense and non-containing offense, and definition we have seen. We have to take the definition from CRPC section 472. So in the context of Companies Act, whatever regular compliances we do, let us take certain instances. What are containing offenses and what are non-containing offenses? So I have tried to make a table for this. Let us first see the left-hand side, containing offenses. So all these are judgments. In Gokak Patel case, it was held that wrongful withholding of property, wrongful withholding of property of the company by its employees shall be considered as containing offense. You can refer section number 452 for this purpose. Let me take an example. Mr. X is the director of RST Limited. He was terminated from his services. And while he was in service, he was given a rent-free accommodation to accommodate. Despite his termination, he never vacated the property given to him for his accommodation. Question arises, is this wrongful withholding of property? Answer is yes. Section 452 is there. And question arose, whether this wrongful withholding of property is continuing in nature. Answer is yes, because the offense is continuing on day-by-day basis. Number second, not issuing share certificate in time. You know very well that share certificates have to be issued within the prescribed time frame. If share certificates are not issued in the prescribed time frame, then it will be considered as containing offense, and it was upheld in Hardilia case. Non-refund of share application money. You must be knowing, if I go to Companies Act, we have section number 42, read with companies acceptance of deposit rules. What is stated there? It is stated that share application money once received shall be allotted within 60 days of its receipt. And if it is not so allotted, it shall be refunded within next 15 days. So if it is not so refunded, from 76th day and onwards, it will be considered as a containing offense. And that was upheld in TV Matthew case. Then non-filing of annual return and balance sheet, a very common default which people commit, is a containing offense. Kishan Prasad versus ROC case. Then if I come to the right-hand side, non-containing offense, non-compliance of accounting standards is considered as a non-containing offense. Please understand, the show cause notice here in Kavi Arora case were issued by ROC. ROC stated that I levy penalty upon you because you are not complying with accounting standards. So those of you people who are listening me as auditors, please be cautious that non-compliance of accounting standards and non-qualification thereto in your audit report may land you into trouble. You means the auditors also. And although it is a non-containing offense. Then non-maintaining proper books of accounts, again non-containing offense. Mohan Raj and Singhi case. In Ramnagar Cane and Sugar Limited case, non-filing of return of fixed deposit was also considered as non-containing offense. So what I have done is, I have not taken most of the examples because they may not be routine sections. These all are routine affairs. And most prominent routine affairs are annual filing, books of accounts, compliance of accounting standards, issue of share certificate, and so on. So please understand, non-containing offense may result in time barring after a particular time frame. But in containing offense, each day give a fresh lease of life. And hence, in that very scenario, you cannot take the defense of a case getting time barred. Am I clear? So this need to be very, very particular. For you, a question is there. A company, ABC Private Limited, never maintained minute book, never maintained shareholder register. Is it a containing offense or a non-containing offense? Think logically, because there is no judgment on the screen. Non-maintenance of shareholder register, non-maintenance of minute book of the company. Very minute examples. Are these containing offenses or non-containing offenses?
Containing offense.
These are containing offenses. So what you need to understand, if these are containing offenses, then they are getting fresh lease of life on each day. Can you please tell me the logic? Why proper books of accounts are considered under the category of non-containing offense? Any logic?
They are supposed to be considered as regular statutory registers which a company needs to maintain.
Yes, because books of accounts are getting closed for each year. So they are considered as non-containing in nature. Although I have a difference of view, they should also be considered as containing in nature. But yes, the judgment is there. Having said that, let me proceed further. Adjudication of penalties. If you remember, just few moments back, we discussed the distinction between fine and imprisonment versus penalty. And that very time I told you penalty can be levied by adjudicating officer. And in most of the cases, this AO, that is adjudicating officer, is ROC. Without searching on Google, can you please tell me what is the section in Companies Act regarding adjudication of penalties? So like in income tax, we have AO. In Companies Act, we also have AO. The only difference is we call him as assessing officer. Here he is known as adjudication officer. So we have section number 454. And I must tell you, this is a very good opportunity for professionals. If a company is getting show cause notice from ROC for levying a penalty, why can't we professionals exercise our professional acumen and defend the case? Because the whole scenario is simple. You can represent your client by understanding section number 454 of Companies Act. So just see what section 454 says. This I already covered. Punishment of fine and imprisonment can be imposed only by the court, that is the competent court, as defined in section number 2, clause 29. However, in certain cases, provision has been made for imposing penalty. Such penalty can be adjudicated by ROC, being one of the designated official as adjudicating officer, section number 454(1). Now, what are the powers of this officer? The powers of adjudication shall be exercised by such officer by an order. Section number 454, subsection 3. And he by an order can do these two things. What are these two things? Impose the penalty or direct the company to rectify the default, or both. So there are two powers given to this AO. Now, whenever show cause notice is issued, that the show cause notice is nothing but giving the opportunity of being heard. So what is the time frame? Subsection 4 says, the adjudicating officer before levying a penalty shall give opportunity of being heard to the company and officers in default, and that show cause notice shall give a minimum 15 days of time to respond back. Maximum time can be up to 30 days. However, this 30 days of time can further be extended for 15 more days for reasons to be recorded in writing. So after recording reasons in writing, the period can go up to 45 days. So 30 days original plus 15 more days can be given. Now, we do have section 454, subsection 5, which prescribes the procedure of appeal if you are not satisfied with adjudicating order. So you can file the appeal to regional director. So ROC will levy penalty. You are not happy with the penalty order, then you can file appeal. Yes, most of the people have a misconception that against this order we will go to NCLT. No, you will not go to NCLT. You will go to regional director first. And when you go to regional director, the entire procedure is prescribed under section number 454, subsection 5. This appeal can be filed within 60 days in form number ADJ, and this form ADJ shall not seek relief therein against more than one order unless reliefs prayed for are consequential. So one order, one appeal, second order, second appeal. You cannot mix up two penalty orders in a single appeal. Am I clear? Are you getting this point? And I must again repeat one thing. This is a tremendous opportunity for professionals. So if you people can deal with income tax cases before AO, you people can deal GST cases before GST officer, why not this case? We can also deal with this case, and procedure is simple, very much similar to what we do as representation services. Then we do have section number 454 capital A. Section number 454 capital A deals with repeated default. I will emphasize on a particular word, this. Please focus on that word. Where a company or an officer of the company or any other person having already been subjected to penalty for default under any provisions of this act again commits such default within 3 years from the date of order imposing such penalty passed by the AO or the RD as the case may be, it or he shall be liable for second or subsequent defaults for an amount equal to twice the amount of penalty provided for such default under the relevant provisions of this act. Primarily, what is the sense coming out? If you are repeating again, the amount of penalty will be multiplied by 2. Question for you people. This means Companies Act only. So there could be a scenario like this. The company is a listed company and default was there in prospectus issue. So one penalty will be levied under Companies Act, second will be levied under SEBI and SCRA. So what is the power of ROC here? Only to deal with company law matters, not the SEBI matters. Are you getting this point? And number second thing, what they say, penalty will be multiplied by twice. Let us take a situation. Don't search on Google, please. The situation is ROC levied a penalty upon you and you lost the appeal also. Say the penalty order was for ₹100 and this section provided the penalty will be ₹500. I'm taking a hypothetical example only just to make the things clear. The section provided ₹500 of penalty, but ROC levied a penalty of ₹100 only. Question arises, when second time this offense is committed, whether the penalty will be ₹100 multiplied by 2 or ₹500 multiplied by 2. So when we have to do twice, this twice means the preceding penalty order or the penalty which is given in the section itself.
Given in the section, sir.
Given in the section itself, because if you see the last sentences, amount of penalty provided for such default. The word is provided, not levied. The word is provided, not levied. So don't be under misconception that twice means whatever penalty was levied, it is penalty provided by the section. I have a small question. Please don't search on Google and reply me. Can I say that in all the cases where ROC has the powers to levy penalty, all such cases are compoundable offenses? Think very, clearly without any kind of guesswork. Can I say that wherever ROC has the powers to levy penalty, all such cases are compoundable cases? Any answer? Priya madam, any answer?
I don't think so unless it is provided under the sections.
A very diplomatic answer, ma'am. Any other person? Okay, let me tell you. Provision, what is the provision saying? We have section number 441. So I'm not giving you the answer. I'm telling the provision. Then you have to give me the answer. We have section number 441, compounding of offenses. Section 441 says, or I should write on the screen because perhaps my accent will be a bit different. Section 441 says, following are compoundable offenses. Offenses punishable with fine or imprisonment. Okay, fine or imprisonment, or both. So question arises, now tell me whether all the offenses where penalty is leviable, are they compoundable? Let me show you one more thing so that the things can become a bit easy. Let me show you the Bayer Act. Give me one moment. It's a very interesting question and you will find the answer in a very small scenario sense. Just give me one moment to show you something. So this is your section number 441. I read something here. Notwithstanding anything contained in CRPC, any offense punishable under this act, whether committed by a company or any officer thereof, not being an offense punishable with imprisonment only or punishable with fine and imprisonment, may either before or after institution of any prosecution be compounded by tribunal, and so on. So if you see the sentence, not being an offense punishable with imprisonment only or punishable with imprisonment and also with fine, can be compounded. What are the words used? The words used are fine and the words used are imprisonment. Penalty word is not used. Now can we say that because the word penalty is not used, fine or imprisonment as the case may be are used. So all those cases where ROC levies penalties are not compoundable. Can I say this thing? Yes, Priya madam. Now the question paper is also leaked. Provision is there.
No, sir.
So that means these cannot be compounded. Any other participant? What is their view? So please take a note of this thing. The thing is, those offenses which are subjected to penalty are not compoundable because the matter is tied up with fine or imprisonment and so on. Are you getting my point? So please be very careful. We generally approach NCLT for all the matters. We cannot. And there's a logic thing also. Offenses can be compounded by NCLT or maybe by RD, regional director. Already you have been given the mechanism. If you are not happy with the order of whom? Order of ROC, you can approach RD. So when internal mechanism is there, how can I take a recourse to section 441? However, whatever order comes up via RD, and if you're not happy, then you can go to higher forums like High Court and Supreme Court. But yes, till then, NCLT has no involvement. Are you getting my point? So you can take a note of this thing. Offenses in which penalty is there, but no fine, no imprisonment is there, they cannot be compounded because section 441 deals only with offenses which are subjected to fine or imprisonment. Are you getting my point?
Sir, is my understanding correct? Where there is an adjudication allowed, compounding
is not allowed. We can have this kind of conclusion. Agreed.
Right.
Okay. So let me proceed further. So these are certain prominent compliances where penalty is impossible. Just for the sake of setting the tone, because things we have covered in letter and spirit. So some of the sections where penalties are impossible are default in complying with provisions relating to intimation and display of registered office of company and display of the name of company, section 12H. Default in sending copies of memorandum and articles to the member within 7 days of payment of fees. Not refunding allotment money, we already covered a decided case law. Not refunding allotment money within 30 days of minimum subscription. Default in provisions relating to private placement. Default in sending notices of audited financial statements. Default in giving required notice of board meeting. This is the most famous offense, I must say. Happens quite a lot. Default in keeping register of contracts or arrangements in which directors are interested. Default in keeping contract of service with the MD and whole-time director and allowing its inspection. So these are some of the prominent offenses which are happening. This number 6 is superlative. It happens a lot. So I will skip these provisions, but I will give a very briefing scenario. What are the various punishments? Section 448 deals with punishment for false statement. If you refer any of the E-forms, you will find reference to section 448. So punishment is prescribed under section 448 for false statement in any return, report, certificate, financial statement, prospectus, etc. If you remember that case law, bad debts, that will fall into punishment for false financial statement. So this section number 448, suppression of facts, and whatever suppression takes place, if it is established, then the penalty will be levied on the defaulting person, and the quantum of penalty will be same as is prescribed under section number 447 fraud. Then punishment for false evidence, we already covered section 449, imprisonment minimum 3 years, maximum 7 years, and fine up to rupees 10 lakhs. Please tell me whether this section 449 is compoundable or not. Section 449 is compoundable or not?
Not compoundable.
Why? The reason is and. So what is compoundable is imprisonment or fine. Imprisonment and fine are not compoundable offenses. Then is punishment where no specific penalty is prescribed. We already covered section 450. Penalty up to rupees 10,000 plus rupees 1,000 per day for continuing default. Up to a minimum penalty is rupees 2 lakhs for company and rupees 50,000 for officer and default or other person. Then we have section 451, punishment for repeated default. I have a small question here. That's why I started this brief scenario. Section 451 says if a default is repeated within a period of 3 years, then the amount of fine and oblique or period of imprisonment shall be twice the actual amount oblique period as the case may be. So the quantum again is getting twice over here. But my question to the house is, what is the difference between section 451 and if I go back, section number 454A? 3-year period is here also, 3-year period is in 451 section also. What is the difference between these two sections? Any answer?
Penalty provided, sir.
Yes, section 454A deals with penalty. Section 451 deals with fine and oblique or imprisonment. Are you getting my point? You can take a note of this thing. 454A is penalty. 451 is dealing with fine and imprisonment or fine or imprisonment. Then is section number 453. Punishment for improper use of limited or private limited. So fine which shall not be less than rupees 500 but may extend to 2,000 rupees for every day for which that name or title has been used. So if the company say ABC Limited, but you are using ABC Private Limited, then penalty can be levied. Or you are a proprietorship firm. Say the proprietorship firm is Ram and Sons, but he is writing Ram and Sons Private Limited or Ram and Sons Limited. In that very case, penalty can be levied under section number 450. Sorry, fine can be levied under section number 453. The word used is fine. So who will levy fine? ROC or the court? If you refer section 453, the word used is fine. Who will levy this fine? ROC or the court? It will be court. Why? Because penalty can be levied by ROC and fine or imprisonment can be levied by court only. Court means competent court of your jurisdiction or special court. Having said that, let me come to the other part of discussion. I will skip 1 or 2 clips because these we have covered orally. Now coming to the fees for filing, etc. Without searching on Google, please tell me whether belated filing with additional fees can be done for every kind of filing. I'm not saying whether belated filing can be done in all the cases. I'm asking whether belated filing in all the cases can be done with additional fees. So say for instance, you're going to file form X with ROC after the due date. Whether ROC will levy additional fees always. Whether additional fees is always leviable. Any answer? So you have to reply me by unmuting yourself because I'm not able to access chat box. Priya ma'am, I can see you. So answer from your side.
No, sir. Unless the section provides.
Yes, section provides. So the foremost thing is we need to remember additional fees can be levied by ROC only when section provides. Section nowhere prohibits you to file belatedly because one time or other time you have to file with additional fees, but additional fees always is not leviable. And please also remember, simply because you have filed a document with additional fees, that will not absolve you from the commission of offense. That is also written in the section. So let us go to the section with a briefing. So we do have this small background, then we'll go into details. So the documents have to be filed within the prescribed time frame as prescribed by various sections. If filing is delayed, additional fees is payable as provided in proviso to section 4031. If late fees is not paid, the document will not be deemed to have been filed. Late fees have been enhanced with effect from 7th May 2018. If document under section 92, that is annual return, or section 137, that is financial statement filing, is not filed with registrar in time, minimum additional fees of ₹100 per day is payable. This additional fees applies to firms like MGT7, AOC4, SBRL, as well as non-SBRL mode, AOC4, CFS. CFS means consolidated financial statements. Relevant section, as Priya ma'am also stated, relevant section must contain the provisions filing of the form with additional fees. So if this section is silent about additional fees, then additional fees is not leviable. But as I told, simply because you have filed a form belatedly by paying additional fees, you are not absolved of the commission of offense. That is also mentioned in the section. And this fees recently has been revised again. And with effect from 1st July 2022, some new provisions also have come up. For revised fees, you have to refer annexure 2 rules, which I have not in my clip, but yes, briefly I will cover. So what section says? See the words very carefully and minutely. Very minutely, I must emphasize. Section 403, subsection 1 says, any document, fact, or information. 3 words are there. Any document, fact, or information. Any document, fact, or information may be submitted, filed, registered, or recorded after the time specified in relevant provision on payment of prescribed additional fees. I have a small question to the House, which I will resolve in some moments. What is the difference between your document, fact, or information? Are they defined somewhere? Keep on thinking. I will come to the conclusion in a while. So the first question which we need to have a brainstorming on is document versus fact versus information. Number second, first proviso to section 4031 is effective from 7th May 2018. Then we have 2 more provisos, second proviso and third proviso, and they're effective from 1st July 2022, which is going to come up in next few days only. So what this first proviso says, where any document, fact, or information, again 3 words are repeated, where any document, fact, or information required to be submitted, filed, registered, or recorded as the case may be, under section 92 or section 137 is not submitted. So section 92 is annual return, section 137 is annual financial statements. So if documents, fact, or information, under section 92 or 137 are not submitted, filed, registered, or recorded as the case may be, within the period provided in those sections, without prejudice to any other legal action or liability under this act, it may be submitted, filed, registered, or recorded as the case may be after expiry of the periods provided in those sections on payment of such additional fees as may be prescribed, which shall not be less than ₹100 per day, and different amounts may be prescribed for different class of companies. So this ₹100 per day is the fees, additional fees, which is prescribed. Earlier it was different. Now it is a kind of each day fees. First question to you people is, what is the significance of this sentence? Without prejudice to any other legal action or liability under this act. The significance is simply because you belatedly filed annual return or annual financial statements, as the case may be, by paying up additional fees. Can we say that I paid additional fees, it was additional financial hardship, and hence penalties prescribed under section 92 should not be levied? We cannot say so, because section itself says that whatever you are paying here as additional fees, it is without prejudice to any other legal action or liability under this act. Are you getting my point? And this is the core thing. So if you say that by paying additional fees, you are absolved of your liabilities, it is a wrong conception. You are not absolved. My suggestion is, after paying additional fees, always go for compounding of offense. And this is the opportunity for professionals also. You must have several clients. who have made this belated filing. So please be under right impression. The right impression is, although the form is submitted and it is accepted by ROC also with additional fees, but company still is in the default. To give the company a clean chit of the default, but recourse we are having, the recourse is to go for compounding. Can we go for compounding? That depends upon whether the offense is punishable with fine or imprisonment or not. Are you getting my point? Having said that, second proviso. The second proviso says, where a document, fact or information, the same words again, as the case may be, in cases other than referred to in first proviso. So that means it is other than for annual return or annual financial statement. In the first proviso is not submitted, filed, registered, or recorded as a case may be, then without prejudice to any other legal action or liability under this act, be submitted with such additional fees as may be prescribed. So that's a very simple second proviso only. First proviso was only for annual filing. Second proviso is for filing other than annual filing. And again, the same thing. Simply by paying additional fees, you are not absolved of your legal liabilities that may arise under the Companies Act. Third proviso to section number 4032, again effective from 1st July 2022. It is in respect of repetitive defaults. Where the default is repetitive nature, then what we'll do? The proviso says, where there is a default on 2 or more occasions in submitting, filing, registering, or recording of such document, fact, or information as may be prescribed, it may, without prejudice to any other legal action or liability under this act, be submitted, filed, registered, or recorded as the case may be on payment of such higher additional fees as may be prescribed. Can you see this word higher? So what is the significance here? The significance is, if the offense is repeated, you have to pay additional fees, but you have to pay higher additional fees. And what is the higher additional fees? For this, we have to refer the annexure to the fees rules. Are you getting my point? Again, the same thing. One thing is pervasive in first proviso, second proviso, and third proviso. Merely by paying additional fees or higher additional fees, the company and the officers of the company are not absolved of their liabilities that may arise for contravention of relevant sections of the Act. Then is penalty, section 403, subsection 3. This penalty is effective from 7th May 2018. What it says, where a company fails or commits any default to submit, file, register, or record any document, fact, or information under subsection 1 before the expiry of the period specified in the relevant section, the company and the officers of the company who are in default shall, without prejudice to the liability for the payment of fees and additional fees, be liable for penalty or punishment provided under this act for such failure or default. So what is the scenario happening? You will be liable for penalty, say in section number 92. You're also liable for penalty under section number 403. Are you getting my point? So provisions are harsh. You cannot take it lightly. And that is the right point, that you need to advise your clients suitably to go for compounding if it is possible for relevant sections, or else you have to face the brunt. Having said that, one question still is pending. Can any one of you make a distinction between document, fact, or information? Let me take an example and then tell me which one goes into document, which one goes into fact, and which one goes into information. So facts are registration of charge. If my memory serves me right, we have to file form CHG1. Now, can you give me examples before I write? Can you give me examples? What are the documents we upload here? One is detail of asset. Second is detail of lender. Third is detail of resolution. These are the main documents. Am I right, Priya madam?
Sir, these are the informations we provide in the form.
No, but the fact is, these are the only attachments, prominent attachments.
Yes, sir.
Now,
mainly we attach the loan document.
Agreement.
That will come up in detail of lender.
Okay.
Like agreement, or I should say loan agreement. Resolution could be like section 180, 1C and section 77. Now, please tell me, I should not write this thing as fact, otherwise they will put a confusion. So out of these 3 points, which one is document? Which one is fact? Which one is information? Because all these 3 things look quite similar. Keep on thinking and think on these lines. Document what is defined in Companies Act, but fact and information is not defined. The fact and information is defined in Indian Evidence Act and certain judicial precedences. So I'm showing you the definitions. Then again, we will come back to this question to have the conclusion. So the question was meaning of the word document, fact and information. So if you refer section 2, clause 36 of Companies Act, section 2, clause 36 of Companies Act says document includes summons, notice, requisition, order, declaration, form and register, whether issued, sent or kept in pursuance of this act or under any other law for the time being in force or otherwise maintained on paper or in electronic form. Then is fact. We do have section 3 of Indian Evidence Act. Section 3 of Indian Evidence Act says fact means and includes anything, state of things or relation of things capable of being perceived by the senses, any mental condition, I repeat, emphasize, any mental condition of which any person is conscious. Section 3 further says the expression facts in issue means and includes any fact from which either by itself or in connection with other facts, the existence, the non-existence, nature or extent of any right, liability or disability asserted or denied in any suit or proceeding necessarily follows. Then is a decided case law of Calcutta High Court in Narendranath Majumdar case. Information in possession means facts. Information in possession means facts or factual material which is under his general control, a conscious or intentional physical possession of the person in close proximity of the object. Having said that, let me come back to this question. So please tell me which one is document, which one is fact, which one is information. First one is Form CHG1. Form CHG1, is it a document, fact or information? See this word, document includes form. So what will happen? This is known as your document. Clear? Detail of asset, detail of lender, detail of resolution. Think here.
Detail of
Read
asset
this.
is fact.
These are facts. Why these are facts? Because resolution represents your mental condition. Resolution represents your mental condition only, no? That is what is the decision of the board. And when you say loan agreement is nothing but consensus between the banker and the borrower. It is again a mental condition. So it will go into facts and facts in the issue. So all these are
Facts.
all these are facts. So can we say there is no information? The information is nothing but information is equal to document plus facts. Am I clear now? So now tell me your form MGT 14 about special resolutions being registered over there. MGT 14, a form is there. Is it a document or not? It's a document. Resolutions attached therein. What are these resolutions? Nothing but facts in the issue. Sum total of these two is nothing but information. Am I clear? Okay. Thank you very much. This is the main thing which we need to understand. So I'm skipping this definition of officer and officer in default because you can refer always the bare law. I have tried my level best for one thing. I have compiled a list where additional fees is permissible and where additional fees is not permissible. So let me come to that list because we are coming to the close of session. So I will take some questions at a later stage. I need to give some time for questions also. So this is the impact analysis of Section 403 pursuant to Companies Amendment Act 2017 and Companies Act Amendment Act 2020. So this is a chart, and Priya Madam, I have mailed this chart to the branch also. You can circulate for your reference. So just see what this chart says. Please excuse me if some spelling mistakes are there, but yes, I have done my efforts to compile this list. So what is this list? First one is serial number, then purpose of form filing, and what is the relevant form. So question is, can it be filed with additional fees or not, and why it can be or why it cannot be reason. So first one is any resolution for which special resolution is passed by shareholders. The relevant form is MGT 14. Question arises, can MGT 14 be filed belatedly? Answer is yes. But can it be filed with additional fees? Answer is no. So MGT 14, when is required to be filed belatedly, need not be filed with additional fees. In fact, you cannot pay additional fees because there is no provision regarding additional fees for filing of this very form. So therefore, this form shall be filed as per the relevant section only. Then is any resolution of board of directors or agreement executed by company relating to appointment, reappointment, or renewal appointment or variation in the terms of MD. So for this, again, you have to file MGT 14 by virtue of section number 179, 197, and section number 117. And can this be filed belatedly? Answer is yes, but no additional fees is payable. Why? Because there is no provision in this relevant section. Then is any resolution to make calls on shareholders in respect of money unpaid on their shares. Yes, the form can be filed belatedly, but no additional fees is payable. The same thing goes for any resolution to authorize buyback, any resolution to issue securities, any resolution to borrow monies. So all these forms, MGT 14 are there, but no need to pay any additional fees. In fact, you cannot pay because section itself is silent. Then any resolution to invest the funds, again, no additional fees. Any resolution to grant loans, intercorporate loans and guarantees, no additional fees. Approval of financial statements and board report, no additional fees. Any resolution for diversification of business of company, no additional fees. Form is common, MGT 14. Then any resolution for amalgamation mergers, MGT 14, but no additional fees. Any resolution for taking over a company, no additional fees. Any resolution for political contribution, no additional fees, section number 182. Appointment or removal of KMP, no additional fees, Rule 8 and Rule 8A. Then appointment of internal auditors and secretarial auditors, section 138 and section 203. Again, no additional fees, but the form is common, MGT 14. So up till now, what is the conclusion coming up? For MGT 14 being belatedly filed, no additional fees provisions are there. Then is voluntary liquidation under section 59 of IBC. You have to pass a resolution and you have to file MGT 14. So if you go into voluntary winding up in pursuance of section 59 of IBC, MGT 14 is required to be filed. But if it is filed belatedly, that is beyond 30 days, no additional fees is payable. Then is any other resolution or agreement as may be prescribed and placed in public domain, the same thing, no additional fees is payable. Filing of form DI 12, appointment, cessation, change of director, no additional fees. Appointment, cessation, change of manager, secretary, CEO, etc., no additional fees. Return of allotment, PS3, no additional fees. Now, increase in share capital independently by company, form SH7, no additional fees. Increase in number of members in case of a company limited by guarantee, no additional fees. Form again is common, SS7. Then is redemption of redeemable preference shares, SS7 form, no additional fees. Here is the scenario which is getting changed now. Declaration in respect of beneficial interest in any shares, MGT 6, section 89. Additional fees is payable on belated filing. Report of AGM, MGT 15. Additional fees is payable, section 121. Copy of financial statements will file with the ROC. AOC for additional fees is payable, section 137 permits additional fees filing. Then is INC 28, which is generally for filing the information with the ROC regarding court orders or tribunal orders. No additional fees is payable because section is not conveying any such kind of thing. Registration of charges, additional fees is payable. Section 77 is applicable here. Satisfaction of charges, CSG4, additional fees is payable. Section 82. Company to inform DIN to ROC, DIRC 3C, additional fees is payable. Annual return, MGT 7, additional fees is payable. So these are major compliances where additional fees is payable or additional fees is not payable as the case may be. Having said that, I have a small question before I wrap up. Just give me one moment. Whether additional fees is in the nature of penalty or fine or not? Any answer? So whatever additional fees ROC is charging,
Fine,
is it in
sir.
the nature of penalty or fine or not?
Fine, sir.
So if you will say fine, then I will say then this has to be levied by court. So please undertake this very statement. You can note this statement of mine. Additional fees is neither a penalty nor a fine. I repeat, additional fees is neither a penalty nor a fine. Rather, it is compensatory in nature. So please never call this additional fees as a penalty or fine. Why I'm saying this thing? I have seen some audit reports. In the audit report, the auditors are reporting that this much of additional fees is paid by the company, and such fine is resulting in poor internal control system. So please never ever call this additional fees as a fine or a penalty, because technically and legally it is a wrong statement. So Priya ma'am, this is it from my side. Should you have any questions, you're most welcome. I have skipped some of the clips in my PPT because they were self-explanatory. So I apologize for that thing. But yes, major overall scenario where it was a technical episode, I have tried my level best to cover. So thanks from my side. And should you have any questions, you are most welcome. I'm stopping my screen share to take up your questions.
Thank you, sir. It was really a wonderful session. Due to paucity of time, we will mail you all the questions, and you can please reply us directly.
Sure, ma'am. Sure, ma'am.
In fact, it has been heavily raining here at present after your session had started.
So this is a good sign, in fact.
Absolutely. Friends, the greatest enemy of knowledge is not ignorance. It is the illusion of knowledge. Kamalji, I'm sure your session has illuminated all our minds. For all the members who've been present here, thank you. I now call upon CA Shankar to present vote of thanks for the session.
Yeah, thank you. Thank you so much for this opportunity. Actually, as our past CCM, MPV sir has started with his remarks that we should know the perspective of the lawmaker, that's the MCA or ministry. I don't know whether the author and the past CCM has already spoken about this. He has gone in the same lines, and wherever possible he has referred the section, and he has also clearly explained the very nice nuances that the CA should know. Now we know it is not a simple affixing our DSC on the form. Forms will be prepared by somebody, and DSC also will be affixed by somebody, and fees will be paid by somebody. It is like that. Everything has become somebody's work. Now our author has taken us through the very best part of the understanding aspect of this section. Very many things are there to refer, but I know the next speaker is waiting and our members also are waiting. Few points I would like to touch upon as a refreshing what are the important points he has touched upon. Riya Madam has told the knowledge is a garden. Cultivation is most important. And the cultivation means unlearn, learn, relearn, listen to the speakers like Garg sir. It is like that. It is a wonderful session, sir. My personal thanks to you for that wonderful presentation, and particularly about the ROC's cross verification of the related party transaction between one document filed by us and another document. It's our own document. So disputing or fighting will be the very difficult part in that matter. When I am giving something else, it's better to give both or keep quiet. It is like that. Mentioning a wrong section means I don't know that section and this section. It will be like that. That is one part you have properly informed. And the very odd thing is this difference between 454A and 451. That is also very important. And I would like our members to kindly go through the PPT to be circulated by the branch received from our speaker. I am sure that he has orally said so many things, and in the PPT I expect much more things. We can at least we can go through few case laws in each slide, not everything. To justify our intense listening to the speaker, we will go through at least one case law of each slide to understand what he has been conveyed and he is trying to convey, and what we are supposed to do while we are doing the attestation function. With this, on behalf of all the members present here, and on behalf of the chairman of the Chengalpattu Kanchipuram branch and the CPE, this committee chairman and the CPE committee chairman, and my personal behalf, my sincere thanks to you, Garg sir. And this package of the 5 days course, you can see from the top to the penalty, they have nicely taken us through the entire gamut of the Companies Act. Thank you so much. And we would like to hear you again in future in an offline meeting. Thank you so much, sir. Thank you so much.
Thank you, Kamalda.
Thank you, sir.
Thank you, Kamal sir.
Geeta ma'am, I am permitted to leave.
Yeah, please. Thank you.
All the best, Ramesh ji. See you very soon. Thank you very much.
Thank you so much, Mr. Garg. Real pleasure listening to you. Thank you.
Thank you, sir. Thank you very much.
Thank you. Friends, now we move on to the second technical session by CAS Ramesh on exemptions to private limited companies and OPCs. I call upon Shri CA Preeta, Madam, to please introduce the speaker.
Thank you, ma'am. On behalf of the Chengalpattu District Branch of SIRC of ICAI, I am happy to introduce the concluding speaker of this virtual refresher course on corporate law, CAS Ramesh sir. He is an economics graduate from Vivekananda College, Chennai in 1978. He has been qualified as a chartered accountant in November 1982 and he has commenced his practice in early 1983. He is currently a partner in SR, BR and Associates LLP. He has passed Information Systems Audit exam conducted by the ICAI in September 2002, securing All India 10th rank. He was empaneled as a peer reviewer with the peer review board of the ICAI. He has presented various papers on bank audit, accounting standards, auditing and assurance standards, and peer review at several CPE seminars organized by SIRC and branches. He has also presented papers at seminars organized by Chambers of Commerce. He has contributed articles in CA Journal and SIRC newsletter. He has also co-authored a book on bank audit. He is a member of Chennai 1 Financial Reporting Review Group, a faculty member for training programs organized by CAG Office Chennai, IOB Staff Training College, Tamil Nadu Commercial Tax Department, etc. He is a volunteer blood donor having A1 positive blood group and donated blood more than 40 times in the last 12 years. With these words, I welcome our Honorable Speaker, CAS Ramesh sir. Over to you, sir.
Thank you, Preeta ma'am, for that lovely introduction. Priya, is there anything that you need to do? You are ready to share my screen?
Yes, sir.
I'm not able to share my screen, Priya.
You'll just have to click on this share screen button, sir.
Because on the share screen, I don't see my PPT on this thing.
Is it open, sir?
It opens to basic and it says whiteboard, screen, and iPhone, iPad.
Is your PPT open, sir?
I will do that. It is open. It is open on my laptop. I have it open.
Can you please transfer it to Priya, sir? She will operate otherwise.
No problem.
Priya, is it okay? You are muted, Priya.
You want me to transfer it to where?
Please try opening here once.
One second. Let me do that.
Madam, உங்களுக்கு ஹாஸ்ட் ஒன்று கொடுத்து பாருங்க மேடம்.
I'm not able to open that, Priya.
Make him co-host otherwise.
So you've been given full rights to open your PPT.
Okay.
You just have to click on it and click on share screen button on the Zoom.
Yeah, the minute I click on share, it only goes to a screen which does not show me my iPad. I mean, my PPT. It shows our screen, the screen that we are now looking at, and a whiteboard. So that's why I'm not able to. Normally, when I click on it, I'll be able to see that.
Can you please share it to the branch immediately? I'll organize it from here.
Okay, I'll do that. Just give me a minute.
Yes, sir.
You want me to mail it to the branch?
Yes, sir.
Okay. Okay, I mailed it to you, Priya. I mailed it to the branch.
Yes, sir. Just give us a minute.
Yeah, sure. Okay, while we wait for that, let's start this thing. Shri Gurubhyo Namaha, salutations to all my gurus, without whose help and guidance I wouldn't be what I am today or where I am today. When the chairman and good friend of mine and your chairman of your branch, Mr. Satyanarayana, called me about 15-20 days back, requesting me to do this session, I readily accepted for only one reason. When I did my articles way back in late 70s and early 80s of last century, we had Companies Act 1956, and I grew up with Companies in 1956, and the treatise written on it by Ramaya. So that is what I knew. And when Companies Act 2013 was introduced, I was already 55 years old and had given up reading. So I thought this is probably a good opportunity to read Companies Act 2013, at least the relevant portions which forms part of my presentation, and therefore I agreed readily. But then I found that I had made a mistake by accepting this assignment for the simple reason that there's so many rules, circulars, and notifications to be read. Unlike Companies Act 1956, which was not a notification-driven act. Companies Act 2013 is a notification and rules-driven act, and therefore it is not sufficient if one only reads the act, but will also have to read the relevant notifications and the circulars that go along with it. And to that extent, I found it very difficult, especially at my age of reading so much, to try and put up a presentation to the members of the Chaggalpet branch, who are all my friends. I think I know at least 50% of the members of the branch, and therefore I thought I must do a good job, and that's what I've tried to do. The only request that I have to all the members, especially to Priya, is not to, even if time does permit, and not to ask any questions to me at the end of the session and embarrass me, because I might not be able to answer your questions. But I will certainly assure you that if you put your questions in an email, I will not only read up and answer it, but I'll get the best possible opinion from the top experts in the city of Chennai on the subject and mail it to you within about 48 to 72 hours. With this small introduction to my preparation of the material
You may have to resend the email, sir. We have not yet received the email.
Okay. Sent it now. I resent it. Yeah.
We will check it, sir.
Right. Sure.
Alternatively, you can start the session before PPT, sir.
No issues at all. I'll do that. Well, I won't be going into all the exemptions granted in the section itself to private limited companies. Some of the sections, even in the section, it is said that this section or this particular subclause will not apply to a private limited company. So I'm not really going into those kind of exemptions. But what I will be going into is the two notifications issued in 2015 and 2017. There are about 22 exemptions given in these two notifications. And there's also a condition that has been granted in that, and also an advisory which has been prescribed in these two notifications that I'm talking about. This is what I would probably be looking at, and from that I have made my presentation. So we will first look at the two notification references giving granting the exemptions to private limited companies. We will then look at the definition of small company vis-a-vis the small and medium company. I will explain why I want that definition to be understood by everybody. Then we look at the chapter-wise exemption listing, and then move on to a clause-by-clause analysis or a detailed analysis of the exemptions. And then finally, we look at the condition for availing exemption. There's only one condition, but it is a pretty important condition. Therefore, we look at what that condition is. The two notifications were issued way back in 2015. The first notification was issued in 2015, notification GSR 464, dated 5th June 2015. This was done with an ease to bring about, to bring about an ease in doing business and to provide a simpler and easier legal framework for the private limited companies to function. And with that objective, the MCA came up and issued the circular in the year 2015. And then they issued one more circular in the year 2017, which is GSR 583E, dated 13 June 2017. Now, the first circular is referred to as the principal notification, because what the second circular did was not an independent circular by itself, but it said that there are insertions made and renumbering of the serial numbers in the notification issued on 15 June 2015. And therefore, the 15th June 2015 circular is referred to as the principal notification. Now, let us look at what these, which are the companies which can avail the exemptions granted by these two notifications. Can you go to slide number 4, please? Yeah. These two notifications apply to a private limited company as defined under section 2, subsection 68 of the Companies Act 2013. Now, what does section 2, subsection 68 say? The section says, private company means a company having a minimum paid-up share capital as may be prescribed, and which by its articles restricts its rights to transfer its shares. 2, except in the case of 1% company, limits the number of members to 200. So that is the private limited company to which we are talking about. These exemptions contained these two notifications apply to only private limited companies defined under section 2, subsection 68. Now, why I brought this to the attention of the members is, there are also companies which are private limited companies, but which are subsidiaries of a public limited company, and therefore become the deemed public limited company as per section 271. Section 2, subsection 71 states a public company means a company which is not a private company and has a minimum paid-up share capital as been prescribed, provided that the company which is a subsidiary of the company, not being a private company, shall deem to be a public company for the purpose of this act, even when such subsidiary company continues to be a private company in its articles. So this is the reason why I brought this to attention. All exemptions granted here are only to companies which qualify to be a private limited company as per section 268 of the Companies Act, and not to be confused with the private company which is a subsidiary of a public company, because they are deemed public companies under section 276 of the 271 of the Companies Act. I want to spend a little time looking at it. Can we go to the next slide, please? Can we go to the next slide, please? I want to look at two definitions. One, a small and medium company, and two, a small company. A small and medium company is a company which is not listed or which is not in the process of getting itself listed in any stock exchange in India. It is not a bank, financial institution, or insurance company. It is not a company. It is a company where the turnover does not exceed 250 crores in the preceding year. Earlier it was 50 crores. Borrowings are not more than 50 crores at any time during the preceding year. And three, which is not a holding or subsidiary company of a company that is not an SMC. This is the definition of a small and medium company. Whereas a small company has been defined as one where the paid-up capital is less than 2 crores and the turnover is less than 20 crores. Again, their exclusion is it should not be a holding company or a subsidiary company. It should not be a Section 8 company, or it should be a company, body corporate governed by any other special act. So in other words, any company which is not a holding company or a subsidiary company or a Section 8 company under the Companies Act, which is a private limited company whose paid-up capital is less than 2 crores and whose turnover is less than 20 crores, will be classified as a small company. Now, why have I brought this definition of small and medium-sized company into this? The Companies Act does not define small and medium companies. Only a small company has been defined by the Act. So where does this definition of a small and medium-sized company come in at all? It comes in the accounting standard rules. Companies' accounting standard rules has defined SMC. Now, it has defined SMC for the purpose of giving some exemptions from accounting standards, disclosure, and measurement for private limited companies, and therefore they have defined an SMC company. They have specifically not called it a small company, they will call it a small and medium company. The accounting rules, the company's accounting standard rules was first issued in 2006 and was amended from time to time. And on June 23rd, 2021, in consultation NAFRA, MCA issued the company's accounting standard rules 2021, which comes into effect for all financial periods commencing on or after 1st April 2021. It says for the purpose of this clause, a company shall qualify as a small and medium-sized company if the conditions mentioned therein are satisfied at the end of a relevant period. Now, let us remember that the SMC definition is only for the purpose of exemption from accounting standard measurement and disclosure, and that also not all, some exemptions given in some accounting standards. Whereas a small company has been defined by the Act, and whenever a reference is made to a small company, we need to look at the definition of the Act and not the accounting standard rules. Again, let us look at Caro. I might be going a little out of the topic that has been given to me, but I thought these are things that we should bring to the attention of the members. Let us look at Caro. Caro, what are the companies which Caro does not apply has been stated in the order. It says companies not covered by the order are 1, banking company, 2, insurance company, 3, Section 8 company, 4, OPC company. So we are not really worried about all that. 5, a small company as defined in Section 285 of the Companies Act, which means we need to look at whether the paid-up capital is less than 2 crores and the turnover is less than 20 crores. If those two conditions satisfied, it will be a small company for which Caro will not apply. Now, the 6th class of companies which are exempt from Caro are private limited companies having a capital and reserves of less than 1 crore as on the balance sheet date, borrowings from bank and financial institution less than 1 crore during any time in the year, and turnover less than 10 crores. Now, here comes the little bit of a confusion. A private limited company whose turnover is less than 10 crores, whose borrowings is less than 1 crore, and whose capital and some reserves is less than 1 crore is outside the ambit of Caro. Now, I would like to take an example where I have a small company where the turnover is 15 crores, and the paid-up capital is 2 crores. Because the turnover is now exceeded 10 crores, will I come under 6, the 6th class of companies for which Caro will not apply? where it says private limited company where the turnover should be less than 10 crores. So if I look at that definition, I will be hit by it, but I'm still a small company because my turnover is less than 20 crores, and therefore I should be the exemption from CARO should be applicable to me. All I want to bring to the attention of members here is, as long as you satisfy the definition of a small company, which is paid up capital being less than 2 crores and turnover being less than 20 crores, you do not have to go further than that and look at the sixth class of companies for whom CARO has been made inapplicable by the order. If you look at paragraph 12 of the guidance note issued by Institute of Chartered Accountants of India on CARO 2020, it says, if a case is covered under a small company, it will be exempted even if it falls under any of the categories prescribed for private limited companies. So please check this. Check whether the company that you're auditing is a small company by the definition of small company in the Companies Act. And if it is so, you can, in your audit report, state, since it is a small company, CARO is not applicable, and therefore that report has not been annexed. Next slide, please. I just want to quickly run through the chapters to understand what are the chapters where we are having exemptions for private limited company. First, we are looking at chapter 1, which is preliminary chapter, which talks about the title, extent, and commencement of the Act, and also the definitions. There are two definitions in section 2, which there have been slight tweaking by the principal notification and which has been made inapplicable to private limited company. The second is we'll deal with chapter 4, which deals with share capital. So what kind of share capital can a private limited company have, and are there any restrictions on voting rights? We will then move on to chapter 5, which deals with the acceptance of deposits by a company, which I think is very crucial for us to understand, because any non-compliance or non-adherence to that particular section, the penalties can be huge. And therefore, we need to be very, very careful about that particular section. Chapter 7, we will look at management and administration. There are 8 sections starting from 102 to 107 and 109, which there are certain exemptions granted by the notification. Therefore, we look at that 8 sections in that chapter 7. Then we'll move on to chapter 10, which talks about audit and auditors. Are there any exemptions in that section for private limited companies? Chapter 11, qualification and appointment of directors. Again, certain exemptions there. Chapter 12, meeting of the board of directors and its powers. Again, some exemptions there. And finally, we look at the exemptions available in remunerating a managing director or a whole-time director, which is contained in chapter 13, appointment and remuneration of managerial personnel. We go to the next two. Can we skip the next 2 slides? It only contains what I spoke about now. Yeah. So the last thing we look at is chapter 13, which talks about appointment of a managing director and overtime director manager. Let's go to slide number 9, please. Section 2, subsection 40 defines the components of financial statements, which includes a cash flow. But there's a proviso. The original proviso said, provided that the financial statement with respect to one-person company, small company, and dormant company may not input the cash flow statements. So it only gave an exemption for small company, OPC, and a dormant company. But now it says it is also added a private company if such private company is a startup company. Now, I don't really know how many of us really do the audit of a startup company, but if you are doing the audit of a startup company, in addition to cash flow not applying to an OPC and a small company or dormant company, it also does not apply to a startup company. I think we need to really understand what is the definition of startup company. The startup company definition has not been given in the Companies Act. It has been given for the purpose of, it is only an explanation to section 240 where it says, for the purpose of this act, the term startup or startup company means a private company incorporated under the Companies Act 2013 or the Companies Act 1956 and recognized as startup in accordance with the notification issued by the Department of Industrial Policy and Promotion, Ministry of Commerce and Industry. So we need to look at that notification to understand which is the startup company. Again, why I'm stating this is, today the word startup is used so loosely that both there are very professionals and businessmen who think that a startup is a company that was started recently. No, it has to abide by the definition given in the notification issued by the Department of Industrial Policy and Promotion, Ministry of Commerce and Industry. And if that satisfies it, and if you're doing the audit of a startup company, you need not file cash flow. To sum up, a cash flow is not required for an OBC, a small company, a dormant company, and a private company, if the private company is a startup company. Next slide, please. The notification says section 2, subsection 76(7) shall not apply to a private company with respect to section 188. What does this mean? Does it mean that the entire section is not applicable to private companies? That is, the entire section 188 is not applicable? Before going into that, let us look at what section 276(7) says about a related party. Related party with reference to a company means any company which is a holding subsidiary or an associate company of such company, or a subsidiary of holding company to which it is also a subsidiary. This is the definition of related party as per 276 clause 7. Because the notification says section 2, subsection 76 clause 7 shall not apply to a private company with respect to section 188. There is lots of people who say the entire section 188 does not apply. I think it is a wrong interpretation. Let us look at section 198 and then conclude whether it does not apply to the entire section or it only does not apply to a portion of that section. Can I have the next slide, please? See, section 188 says, except with the consent of the board of directors given by a resolution at a meeting of the board and subject to such conditions as may be prescribed, no company shall enter into any contract or arrangement with the related party with respect to, and it listed out quite a few things: sale and purchase or supply of goods, leasing of property, selling or otherwise disposing of the undertaking, availing or rendering of any services, appointing of any agent for the purchase of sale of goods or materials. Such related parties appointment to office or place of profit, underwriting the subscription. About 7 types of businesses, no company except with the consent of the board of directors by a resolution at a meeting of the board and subject to such conditions, no company shall enter. Because the word no company has been given there, I don't think the notification saying that this will not apply to section 188 means it will not apply to subsection 1 of section 188. Where it probably applies is, there is a proviso to the section, second proviso to the section, which says, provided further that no member of the company shall vote on such resolution to approve any contract or arrangement which may be entered into by the company if such member is a related party. So, if there is a related party among the members and he is participating in voting, he cannot vote. Is the second proviso to that section. I think the notification when it said it will not apply to 188, it was referring to 188(1) second proviso, and therefore in the case of a private limited company, even if the member is interested in it, in the related party transaction, he can vote at it, and that is the exemption that has been given, and not exemption from the entire section, which is what some of the some people are harping on. I don't think that is the right interpretation. I am willing to stand corrected if somebody says no, it applies to the entire section. But in my consultation with some of the experts in the city of Madras, they said it can apply only to the second provision, and not to the entire section. Can we go on to the next slide, please? The section 43 talks about different types of share capital, and 47 deals with voting rights. The notification says both the above sections shall not apply to a private company, where the memorandum or articles of association of private company so provides. Now let us look at section 43 first. 43 says the share capital of a company shall be of two kinds, namely equity share capital and preference share capital. In equity share capital, they are further subdivided into saying with voting rights, with differential rights as to dividend, voting or otherwise, in accordance with such rules as may be prescribed. So which means we have equity share capital, preferential equity share capital, and preferential share capital, which is what it is. Now, can a private limited company say I will have only preferential share capital? Is that possible at all? Or is it not possible? In my opinion, and in consultation with a very senior company secretary who also happened to be a very senior officer of the MCA, she is of the view that the ministry will not allow a private limited company to be incorporated only with preference share capital. It has to be always with the equity share capital also. Then what is the exemption that we are looking at? I think the preferential equity can be done anyway. You could issue equity shares where the voting rights are restricted. You can say these class of equity shareholders will not have the right to vote. They will not have. They will have less preference in dividend, in the sense that if dividend is to be paid, then the A class of shareholders will be paid 5% more dividend than what is described to B class of. That is the kind of thing that the private limited is given exemption from, and not from the entire section, and therefore says I will have only preference share capital. Again, something which we need to look at. I personally, in all my 45 years of being a chartered accountant, I have not come across a private limited company with only preference share capital as its capital and not equity capital, and therefore I think that's what it should apply to. Again, in voting rights, subject to the section 47 says, subject to the provision of section 43, every member of a company limited by shares and holding equity share capital, then should have a right to vote on a resolution placed before the company, and his voting right on a poll shall be in proportion to his share of the paid up equity capital of the company. Now, the private limited company say it need not be in proportion. It can have any kind of condition for the poll, but it need not necessarily be only in proportion to the share that he holds in the paid up capital of the company. And these are the kind of exemptions that has been given by the notification. I think a plain reading of the notification without reading the act actually leads us to a wrong interpretation as if the entire section is not applicable. But I think if we are able to look at what the intention of the legislature is in the section and read the notification in consonant with that intention and the actual section, we will be able to distinguish what exemption has actually been given to the private limited company in these sections. Can we go to the next slide, please? We talk about further issue of capital. When there is a further issue of capital, is a rights issue. Section 62(1)(a)(1) provides that there must be a time period for the offer of the rights issue, and it shall not be less than 15 days and shall not be more than 30 days from the date of offer. Section 62(2) also mandates dispatch of the notice of the rights issue at least 3 days before opening of the issue. This is what it talks about. Now the notification says that this need not be the case. The provisional notification states that in case 90% of the members of the private company have given their consent in writing or in electronic mode, the period lesser than those specified in the said subclause or subclause or subsection shall apply. In other words, in a private limited company need not wait for a minimum period of 15 days and can close its offer of rights issue in less than 15 days time. The period may be reduced to less than 15 days, but it cannot be extended within 30 days. This is my interpretation. You can keep your rights issue open as a private limited company. You can keep your rights issue open even just for 1 day. Nothing prevents you from doing it. But can you have it for 31 days? I don't think so, because the Act has said it can be less than 15 days, but not more than 30 days. And therefore, you cannot exceed that. It can be less than 15 days. Shall not be less than 15 days. I think a private limited company in its articles can provide that it will be open only for 1 day or 2 days or any date which will be less than 15 days. Those kind of alterations they can do in their articles and memorandum and ensure that they follow that. They can also state that it is sufficient compliance if a notice is dispatched within less than 1 day before the meeting and not 3 days as has been stated in the section. So again, when we say that 62(1)(a)(1) and 62(2) will not apply, what it actually means is it is not as if you can't have a rights issue without a notice. There has to be a notice. There has to be an offer. Therefore, the time limit for the notice and the time limit for which the offer will be kept open, the private limited company has enough leeway to play around with that. What about rights issue made to as ESOPs to its employees? Now, section 62(1)(b) states. Can we go to the next slide, please? 62(1)(b) says that in the case of a rights issue to employee, in the case of employee stock option under a scheme, it shall be done by a special resolution. Now, that can be done in the case of private company. The requirement of passing a special resolution has been done away with, and you can go in for a simple resolution is sufficient. Because again, 62(1)(b) exemption has been given to a private limited company. Therefore, but can you do it without passing any resolution? I don't think so. Obviously, there is an ESOP, there is a scheme. Therefore, there has to be a resolution for it. If somebody says because 62(1)(b) has been exempted by that notification, by the principal notification, we don't need to do anything, I think that will be a wrong interpretation. A resolution has to be passed, but it need not be a special resolution. It is enough for the ordinary resolution. Next slide, please. Now, this the principal notification says, Chapter 5, Section 67 shall not apply to private companies in whose capital no other body corporate has invested any money. 2, if the borrowing such company from banks or financial any body corporate is less than twice its paid up capital or 50 crores, which was lower. And 3, such company is not in default in repayment of such borrowing subsisting at the time of making transactions under this section. The notification only talks about Section 67 and says it shall not apply to private companies, which fulfill certain conditions. What are those conditions? The share should not be held by somebody else. It is should not have borrowings of more than 50 crores or twice its paid up share capital, which is lower, and there should not be any default in the loan that has been taken from the bank or financial institutions. What does Section 67 talk about? Section 67 says, subsection 1 talks about no company limited by shares or by guarantee and having a share capital shall have the power to buy its own shares unless the consequent reduction of share capital is effected under the provisions of this Act. In other words, there is a prohibition on companies buying their own share unless it is with an intention to reduce the capital, which is dealt with by Section 68, buyback of shares. So, Section 67(1) says you cannot buy back shares and keep it as an investment. Because if you are going to buy and it does not lead to a reduction of the share capital, then where will it be kept in the asset side? As investments. Can a company hold its own shares as investment? While it is allowed in some companies the world over, in India it is prohibited. So when they say Section 67 shall not apply to private companies, does it mean 67(1) does not apply? I think that will be a wrong interpretation to come to. And if they say, if for a minute, let us agree that Section 67 shall not apply. Section 67 prohibits the company from buying shares of it or its own shares unless it is for the purpose of reducing the capital. So if I say it does not apply, can a private limited company buy its own shares and keep it as investment? I don't think that's the right interpretation. The right interpretation will be the second subsection 2 of Section 67, which is no public company. Please look at the words used. In Section 67(1), it says no company limited by shares, whereas Section 67(2), it says no public company shall give directly or indirectly by means of a loan or guarantee or the provision of security or otherwise any financial assistance for the purpose of or in connection with a purchase or subscription to be made by any person or for any shares in the company or its holding company. Now, this is the exemption that has been granted. A company can give loan to any person to buy its own shares or subscribe to its share capital, and not from the operation of Section 67, subsection 1. Now, the only thing that I would like to draw the reference to members, other than what is stated in Section 67(2), which by the notification is not applicable to private limited company, the minute and loan is given by the private limited company to any person who is an existing shareholder to subscribe for more shares in the company, it will amount to, although it will be in compliance with company law, it might attract the provisions of Section 2, subsection 22, clause E of the Income Tax Act and might be treated as deemed dividend in the hands of the shareholder who has availed a loan to buy further shares, and that should be something which we need to look at before we advise the client of this. Can we go to the next slide, please? The acceptance of deposit is always a very scary thing as far as I am concerned, because there are so many rules and so many conditions we complied with before accepting deposits. And therefore, I'm very wary of a private limited company accepting deposit. And those clients of mine who have accepted deposit, the focus of audit on acceptance of deposit and compliance rules is really high, because any mistake there can lead to a huge penalty from the from both RBI and ROC. So we need to look at that. Now, clause, a company may accept deposits by issuing circular to its members, filing a copy of the circular, certifying that the company is not committed any default, by providing security, by, if any, for the repayment of the amount deposit, all that it can accept deposits. The notification says, Chapter 5, clauses A to E of subsection 2 of section 73 shall not apply to a private limited company. 73(2) says, these are the clauses I've listed there, you can see it on the screen, which have to be, which are to be done by any company which accepts deposits. The fact that the notification stated that these are not, well, they need not be done with, I think you don't have to comply with this for the purpose of accepting the deposits. But you need to comply with certain conditions to avoid the exemption. And what are those conditions is what we will see in the next slide. These exemptions are available only when the private limited company accepts from its members money is not exceeding 100% of the aggregate of the paid-up share capital or free reserves and securities premium. 2, which is a startup company or for 5 years from the date of incorporation, or which fulfill the following conditions. Those conditions will be taken. So the minute you, if you're looking at private limited company accepting deposits, please do not assume that A to E shall not apply, because you also have to look at those conditions. The conditions which are stated in the which you can now see on the screen. If all those conditions are satisfied, then the private limited company need not comply with clause A to E of section 73 and 73(2) and go on and accept deposit. But please remember that the details of monies accepted must be filed with the registrar in such manner as may be prescribed. Next slide, please. Although this is not part of the syllabus, I'm going into the acceptance of deposit rules, because I think, again, this is something which I have noticed in quite a few companies where auditors have probably slipped up in this, or we may slip up. Now, clause 2 of the acceptance of deposit rules, the company's acceptance of deposit rule 2014 defines what is a deposit. And it says deposit includes any receipt of money by way of deposit or loan, or in any other form by a company, but does not include and list out what are all the things which will not be considered as deposit. I would like to draw the attention of the members to clause 7 of that, where it says any amount received from a person who at the time of the receipt of the amount was a director of the company or a relative of the director of the private company. So you find, when you are auditing, you find loan from directors. So the first question that you need to ask is it really from the directors or relatives, or is it from somebody else camouflaged as loan from director? If they say it is from director or their relatives, then the next thing will be asked for is what has been said in the proviso. It states that they must give an undertaking to the company that the money that they have given is not out of borrowed funds, but it is out of their own sources. If that declaration has been given, I think you can look at it as not, you need not consider that as deposit, but can look at it as loan from director. Now, the question that arises here is, how are we sure that it is from their own sources and not from borrowed funds? That is why a declaration has been prescribed for by the Companies Act. The problem comes in when you are not only auditing the private limited company, but you're also filing the income tax returns of the director or the director's relatives who have lent money. Now, if you are filing the income tax returns, you would have looked at the financial statements and the bank statements of the person who lent the money. You would have known whether he borrowed money and lent it to the company or he gave it of his own sources. If you find he has borrowed money and lent it to the company, are you not taking a risk by relying on the certificate that is given and not qualifying a CARO which talks about this particular question? I think we need to be very careful. If we are doing the audit of both the private limited company and also filing the return of the directors, we could be in a problem when we're dealing with this clause. We need to look at it very practically and see how we can overcome this particular problem that we may have when we're doing the audit of a private limited company, which has accepted money from depositor from the directors, and which we might have a small doubt that it might not be from their own sources, but from borrowed money. Can you go to the next slide, please? Section 92(1)(g), very pretty simple. It mandates the disclosure of remuneration of directors and whole-time directors in the annual return and also key management personnel. However, in the case of small company, it is sufficient to disclose the aggregate amount of remuneration paid drawn by the directors and not individually, which is the only thing. A very, very simple exemption. I really don't understand how much these kind of exemptions benefit a private company from compliance, but then it is an exemption listed out in the principal notification and it's there on your screen now. Can you go on to the next slide, please? Annual return. The provision to section 92(1) says the annual return must be signed by a director and the company secretary, or where there is no company secretary, by a company secretary in practice. The first provision said, in the case of a one-person company or a small company, it may be signed by the company secretary, or where there is no secretary, it can be done by a director. Now, the notification only said, in addition to a one-person company and a small company, a private company, which is a startup company, also it can be signed by one director. Again, I don't really understand the reason behind these kind of exemptions. They seem to be more for the purpose of statistics rather than for actually helping out any compliance issue, either for the company or for the auditors or for the company secretary. But then again, that's something which is which has been listed as an exemption in the notification. I thought I should bring it to your attention. Next slide, please. We are now moving on to management and administration, in which we are looking at almost 7 or 8 sections. We are looking at the section 101, which talks about notice of general meeting, which then we look at statement, section 102, which talks about statement to be annexed to the notice, 103, which talks about quorum, 104, chairman of the meeting, 105 proxies, 106 restriction on voting rights, 107 voting by show of hands, and demand for poll, section 109. The notification says that above section shall apply. It does not say shall not apply. It says shall apply unless otherwise specified in respective sections or the articles of the company provide otherwise. In other words, if the articles of company have something of our company as provided otherwise than what has been provided in the section within the framework of the law, that will prevail and not what has been stated in the section. When we go to the next slide, I would like to take a few examples to understand what we actually mean by this. This is what it actually means. Private companies can now have the option of to provide for their own regulations with respect to what has been listed there, to the exclusion of the corresponding provisions of the Companies Act 2013. Now that's very clear. But then, notice of general meeting. Can I say no notice will be given? I don't think so. A notice, you can have any number of days for the notice. You don't have to necessarily go by what has been stated in the Act, but you can specify your own period for notice. If you say 6 days, then 6 days notice must be given. Even a 1 day notice is fine, but that should be stated in your articles. And if that is stated so, that will prevail and nothing else. Statement. Can the section 102 talks about a statement to be attached to the notice in the case of special business, listing out the nature of concern or the interest. What is the nature of the resolution? What is the nature of the concern or interest, or financial or otherwise, and how of every director, every KMP, and any other information and facts that will be relevant to the member who voted. Now, I can provide in my articles for a private company that no notice will be attached to. No. But in my opinion, it will not be good governance. In my opinion, corporate governance means transparency, and if your article provides that no notice will be given, it will prevail. But is that good governance is a question that we must consider. One of the company secretaries, a very well-known company secretary whom I have a lot of regard for, said, Ramesh, what you need to do is, in your article, you must state that it will not be, need not be attached. But in practice, you must attach it. Only in those particular 1 or 2 instances where you don't want to attach it, you can always not attach it. I think that's a very practical way of looking at it, and that's what we should do. Quorum for meeting. What should be the quorum for the meeting? Quorum for a meeting is been defined as 2 for a private limited company and 3 for a public limited company by the Act. Now, is that right? Can I have only one person as quorum? I obviously can't. But I can always specify a quorum of more than 2, provided I have brought into my articles. I can't say 1, but I can say anything more than 2. That's not a problem. Chairman. The chairman normally should be elected by the members present there, but in a case of a private limited company, the articles can provide. It can in fact even name one person who will be the chairman. Of course, as long as he's alive, he will be the chairman. Or it can say the managing director at that point of time, if he is the member of the company, shall be the chairman. Whatever you want to put, you can put there. But it must very clearly say who will be the chairman. And as long as that clarity is there in the articles, that will prevail over the Companies Act. Proxies. Again, when it comes to proxies, in the case of public limited companies, the member who appoints the proxy appointed by a member need not be a member. But in the case of private companies, I can in my article say, if a member appoints a proxy, the proxy should also be a member. A non-member cannot be a proxy. I can say you only need, and in the notice, I only need to bring to the attention of the member that he has a right to appoint a proxy. I don't have to necessarily keep a proxy form as in the case of public companies. All that is required in the notice of meeting is to bring to the attention of the shareholder that he has a right to appoint a proxy. I can prescribe my own format for the proxy form. I can say it should be deposited, or it can even be brought by the proxy directly to the meeting. I don't have to say it should be deposited before 3 days before the meeting. No, I can put what I want to, but again, it should be put into the articles clearly. Voting rights. The Act says you will not have the right to vote if there are calls pending. The private limited company articles can say even if calls are pending, the shareholder the member has not paid the calls pending calls, he can vote. That condition can be put in by this thing. It's very clear that all these 8 sections we're talking about, you can put any kind of clause that you want there, as long as it is not completely away from the law. It is in spirit or in line with the law, but you are reducing the time or the process. Voting by show of hands. Now, the section which says voting can be by show of hands, your articles can specify that vote by show of hands will not suffice and always be a poll. You can say that if you want to. If you have not said that and there is a demand for poll, you can also state in your articles that there can be no demand for poll. But do you want to do that again as part of corporate governance? Something which you need to look at before you draft the articles. To sum up, any kind of clause can be specified in the AOA, but in my opinion, it should be in line with the spirit of the law. Especially for these 8 sections, you can draft your own clauses in the articles, but please ensure that they are not far away from the spirit of the law. Go to the next slide, please. Section 117(3)(g). 117(3)(g). The exemption has been given from section 117(3)(g) by the principal notification. 117(1) says a copy of every resolution in respect of matters specified in subsection 3 shall be filed. Subsection 3 talks about various resolutions that needs to be filed. It talks about a special resolution that needs to be filed. It talks about a resolution that has been agreed to by all the members. If or with such agreement should have been passed as a special resolution, would have been passed as a general resolution. It talks about any board resolution relating to the appointment, reappointment, renewal of appointment, or change the terms of remuneration of a managing director or a whole-time director. It talks about resolutions agreed to by a class of shareholders. And it talks about resolution passed in pursuance of section 3 of section 170. All these resolutions must be filed with ROC within 30 days of passing the resolution. But the notification says that 117(3)(g) will not apply to a private company. That is, resolutions passed in pursuance of subsection 3 of section 179 alone you need not pass. In other words, if the private limited company has passed a special resolution, it will have to file. If it has passed a resolution which is agreed to by all the members, and therefore an ordinary resolution will suffice, otherwise it should have been a special resolution, that has to be filed. any board resolution regarding terms of appointment, change, or reappointment of the MD or a whole-time director must be filed. What need not any resolution by a special class of by some class of shareholders need to be filed. What need not be filed with the registrar of companies is only those resolutions that have been passed in pursuance of subsection 3 of section 179. Let us look at what are the clauses in 179.3 which the board can exercise, and in the case of private company need not file a resolution under section 117. Next slide, please. 179.3 says a board shall exercise certain power by means of resolution passed at the meeting of directors, which are listed there, making calls, issuing securities, borrowing monies, investing funds of the company, approving financial statements, approving mergers and amalgamations. Now, these resolutions passed by the board need not be filed with the registrar of companies because of the exemption granted in serial number 8 of the principal notification under section 117.3G. These resolutions passed under 117.3 need not be filed with the registrar. This is actually a good relaxation to private company. Otherwise, there are several cases where we have to keep filing resolution copies with the registrar of company. To that extent, there is a compliance de-burden in the case of private companies by this particular exemption. Excuse me. Can you go to the next slide, please? So what we are discussing in the last 2 minutes has been summed up there. Notably, and provides that section 117.3G shall not apply to a private limited company, which means form number 14, MGT 14 for resolutions passed by the board in excess of powers under 117.3 need not be filed by a private company. But please note that a private company will be required to file form number MGT 7 in respect of other matters specified in section 117.3 of the Companies Act 2013. It is only for resolution passed under 179.3 of the Companies Act that you do not file the MGT 7, MGT 14. Next slide, please. We now move on to audit of eligibility. This is simple, not very complicated, extremely simple. But let us look at but before going into that, let us look at the rotation of auditors and then look at this. Section 139(2) of the Companies Act says no listed company or a company belonging to such class or classes of companies as may be prescribed shall appoint or reappoint an individual or an auditor for more than one term of 5 consecutive years, and 2, an audit firm as auditor for more than 2 terms of 5 consecutive years. So 139(2) talks about rotation of auditors. It says no listed company or a company belonging to such classes of companies. Now, where is the such classes of companies defined? It has been defined in the audit and auditors rules. Class of companies has been defined as, for the purpose of clause subsection 2 of section 139, the class of companies shall mean the following class of companies, excluding one-person companies and small companies. Therefore, one-person company and small companies, there is no need of rotation at all. Doesn't mean it applies to private limited companies. Rotation applies to private limited companies. Let us read the rule again. For the purpose of subsection 2 of section 139, the class of companies shall mean the following class of companies, excluding one-person companies and small companies. What are the class of companies? A, all unlisted companies having paid a share capital of rupees 10 crores or more. B, all private limited companies having paid up share capital of rupees 50 crores or more. All companies having paid up share capital of below threshold limit mentioned in A and B above, but having public borrowing from financial institutions, banks, or public deposits of 50 crores or more. So, all private limited companies having a share capital of 50 crores or more, there's no rotation. Less than 50 crores, there's no rotation. Only goes more than 50 crores. Or, if the borrowings of a private company is more than 50 crores, also it will apply. Again, the reason why I brought this to the attention of the members is, invariably, I find that among the members and the students, there is a general understanding that rotation of auditors does not apply to a private limited company at all. It does apply. Under certain circumstances, it will apply. If the threshold is crossed, it will apply. Otherwise, not. Again, what's so big about it? We're not going to have private limited companies in our audit firm which has more than this limit. I think once it fixes in your mind that it does not apply to private limited company, we could slip up when it actually comes to accepting the assignment of a private limited company or continuing to be the auditor of that company. We need to look at if the conditions are satisfied before we are reappointed and the rotation of auditor does not apply to it. Coming to 141(3)(g). Can you go back to the previous slide, please? The section 141(3)(g) says you cannot be appointed as auditor for more than 20 companies. But the principal notification is inserted that after the word 20 companies, other than 1% company, dormant companies, small companies, and private companies having paid up share capital less than 100 crores, you can have more than 20 companies. Which means, again, a private, small and medium practitioner can have more than 20 companies as long as they have private companies with share capital less than 100 crore rupees. The minute it exceeds 100 crore rupees, it will not get counted. It will get counted for the 20, and you will have to probably see whether that applies to you. Otherwise, private limited companies, the 20 restriction does not apply. Only if it's more than that share capital will it apply. Next slide, please. This is a very important clause. I think we need to look at this clause, not so much from the point of view of compliance with the company, but so much from the point of view of whether we should give a report on internal financial control over financial reporting. The clause is very straight. The exemption is very straightforward. 143(3) states lists out what are all the components of an audit report, and clause I states that an auditor shall report on whether the company has adequate internal financial controls with reference to financial reporting and whether they are operating effectively throughout the year. So I given to my audit report, I give an annexure which talks about internal financial controls over financial reporting. How much of check do I do there, and what are the kind of questionnaire that I need to prepare and fill up after observing and doing an audit? Moot question, but I need to give that report. Can I check and find out whether that clause actually applies to the private limited company which I'm auditing? The above clause shall not apply to a private limited company is what the notification says, provided which is a 1% company or a small company or which has a turnover less than rupees 50 crores as per the latest audited financial statement, and aggregate borrowings at any point of time does not exceed 25 crores. I would urge all the members to please see whether first of all, your audit is a small company. If it doesn't fall in the classification, whether this clause will apply, and then look at whether IFCR is required or not. Why I bring this to the attention of the members is only two things. I have come across several private limited companies' financial statements as a part of a research that we undertook in our office, and also as part of the bank audit work which we do, where, in my opinion, the internal financial control reporting was not required at all. But an internal financial control reporting has been given. And the internal financial control report is a clean report, not a qualified one. But if you read the notes to accounts, it talks about non-confirmation, it talks about non-reconciliation, it talks about, the CARO talks about, statutory dues not being remitted properly. It talks about books not being maintained properly. I mean, the fixed asset register not being maintained properly. With all this, how can you give a clean report in your internal financial control over financial reporting? All I am saying is, do not give a report unless it is absolutely necessary for you to give that report. So please look at whether it applies to your auditing before doing it. And that is the reason why I said this is something which really interests us, and we should look at this particular exemption very clearly and understand which are the companies it will not apply. Can we go to the next one, please? Geeta ma'am, is the time up?
No, you have 10 more minutes.
Thank you. Thank you.
Yeah.
Normally, a retiring director, the right of a retiring director to stand for directorship is what is dealt with by section 160. And the right of a person other than a retiring director to stand for directorship has been given by section 160. It only says that the candidate must give in writing 14 days prior to the meeting about his intention to stand for directorship and should pay a deposit of rupees 1 lakh. The principal notification has stated that section 160 is not applicable to a private limited company. In other words, in a private limited company, anybody can stand for listing without giving 14 days notice and without depositing 1 lakh can stand for directorship. Next slide, please. This is again again this is an exemption which, in my opinion, is a statistical for reason. It only says, unlike in the case of public companies where every director's resolution, every director's appointment will be voted singly, individual resolutions will be passed. In the case of private companies, it says you can pass a joint resolution for appointment of 2 directors or 3 directors at the same time. And what kind of an exemption is this? Other than taking 2 more minutes in the case of 2 more minutes in the board meeting, it really doesn't matter. In fact, when we talk about board meeting, remember I told you that I did my articles in 78, 80, 81. My principal under whom I did articles was an extremely fine human being and a great humorist. When we spoke about minutes of board meeting, he would always say, what is this board meeting that we are talking about? And please remember, members, that during those times, most private limited companies, the directors were their husband and the wife and nobody else. I think even today, most of the private limited companies are like that. So he would always jokingly say, what are we talking about board meeting? It should be called a bedroom meeting. And I think that is what these kind of exemptions actually give us. Instead of passing 1 resolution, you can pass 2. Instead of passing 2 resolutions upon 2 directors, you can club it and pass it as 1 resolution. So it really doesn't make any sense to me. Next slide, please. Board meeting. Instead of 4 board meetings, a 1-person company, a small company, dormant company can have only 2 board meetings in a year. 1 each in every half year of a calendar year. Which means from January to June, 1 meeting must be held, and from July to December, another meeting must be held. There is one condition though. It says the minimum time period between 2 meetings, between 1 meeting and the next meeting, should be 90 days. In other words, you can't hold 1 meeting on the 31st of December and 1st of January and say 2 meetings is over, or 30th of June and 1st of July and say 2 meetings are over. There should be a minimum gap of at least 90 days between 2 meetings. This is the exemption that has been given to a 1-person company, a small company, and a dormant company in terms of meetings of the board. Can you go to the next slide, please? See, the quorum for a meeting of the board, it shall be higher of 1/3 of its total strength or 2 directors, which is what the law states. And it also states that in case the number of interested directors exceeds or is equal to 2/3 of the strength of the board, the number of directors who are not interested and present at that meeting, being not less than 2, shall be the quorum for during such time. The principal notification states section 174(3) shall apply to a private company, but it says that those people will be counted for the purpose of quorum. After disclosing their interest, they will be counted for the purpose of quorum, and not like in the case of public limited companies that they will not be counted for quorum. The directors will be counted for quorum. They are interested, but they will be counted for quorum as long as they have disclosed their interest pursuant to section 184. That's again a very important exemption given, and I think without that, the entire functioning of private limited would have been affected. Can we go to the next meeting and next slide, please? Restriction to the board of directors. Section 1, the principal notification states section 180 shall not apply. Does it mean that section 180, which talks about the board's rights, the board powers to act or to do certain activities, does not apply to private limited company? Again, I don't think so. Section 180 says that the board shall exercise certain powers only with the consent of the company by a special resolution. When it says it will not, when the notification says 180 will not apply to a private limited company, all it means is the board can exercise these powers without the consent of the company by a special resolution. That is what it means. It does not mean the board cannot exercise those things or anything. It has to do it, it will do it. So if you go to the next slide, we can see the board of directors may exercise these powers without restrictions under 180, that is without obtaining the consent of the company by a special resolution. That is all it means. That does not mean that the board cannot do it or board need not do it. Anybody can do it. It will still the board will have to do it. And not the CEO of the company who is not a member of the board, he cannot exercise those powers. It still have to be exercised only by the board of directors. Disclosure, can next slide, please. Disclosure of interest by a director, which is what we saw already. Yes, he has to disclose, but he may participate in the meeting after disclosure of interest. He can participate. In the case of public limited company, he cannot participate. Here in the case of private limited company, 184(2), exemption has been given for him to participate in the meeting after disclosing his interest. Next section, please. Next slide, please. Sorry. One 185 talks about loan to directors. It says no company shall advance any loan to any of its directors or other persons in whom the director is interested. Certain exceptions have been provided for in the section. It says section 185 shall not apply to a private company if the following conditions are satisfied. What are the conditions? The company's share should not be held by any other party corporate. 2, the borrowings of the company should from banks or financial less than twice of its paid capital or 50 crores or lower, and such company are not defaulted. So if those conditions are satisfied, the loan can be given to a director. But then again, my question is, as an auditor, the only thing I would look at is giving a loan to the director will deemed dividend be attracted by section 2 subsection 22 of the Income Tax Act. We cannot look at only the exemption given by the principal notification, therefore a benefit has been given, the company can advance loan. If your auditor asks, sir, can I give a loan to the directors, and you say yes, I've completed the thing, yes, you can. I think you will actually be doing a disservice to the client because he will get hit by 222E of the Income Tax Act. Keep that also in mind when you advise your client on loan to directors. Next slide. So that's what this slide says. Private companies fulfilling the specified conditions can advance loan. You can also give a guarantee, but then you will definitely need to look at 222E. Next slide, please. Principal notification says that section 194 says principal notification serial number 16 says subsection 4 and 5 of section 196 shall not apply to a private company. 196 deals with appointment of managing director and full-time director. It does not apply to only 4 and 5. It applies to the other to all other clauses. 4 mandates what and 5 mandates what. 4 only says talks about subject to the provisions of section 197 and schedule 5. A managing director, whole-time director, or manager shall be appointed in terms and conditions of such appointment and remuneration payable be approved by the board of directors at a meeting which shall be subject to approval by resolution of the next general meeting of the company and by the central government in case such appointment with variation with the conditions specified in part 1 of the schedule. So essentially, the sections first subsection 1 of section 100 says no company shall employ or appoint at the same time a managing director and a director. Subsection 2 of section 196 states no company shall appoint or reappoint any person as its managing director, whole-time director, or manager for a term exceeding 5 years at a time. I think this clause will apply to a private limited company also. Third, no company shall continue to shall appoint or continue the employment of any person who has attained the age of 70 or below the age of 21. I think all those clauses will apply to private. What will not apply is 184. You can fix any kind of remuneration you want for a director, managing director, or a whole-time director of a private limited company because you're not more by Schedule 5, and that is why 194 and 195, which 195 which talks about any act done before approval will not be invalidated if the approval is not granted by the company in general meeting or by the central government, as the case may be. So the exemption for a private limited company from 196 is only for subsection 4 and 5 and not for 1, 2, and 3. Friends, these are the various exemptions that have been contained in the 2 notifications issued in 15 and 17. There are other exemptions available in the section itself where it says in the last clause or in the opening it says other than a private limited company. So please look at that. But there is one condition for availing these exemptions. The exception, this has been provided in the principal notification para 2A. The exceptions, modifications, and adaptations provided in column 3 of the aforesaid table, which is that's been given in the form of a table in the notification, shall be applicable to a private company which has not committed a default in filing its financial statements under section 137 of the said act or annual return under section 92 of the said act with the register. In other words, if the financial statements have not been filed or the annual return has not been filed, then these exemptions are not available. Now, what do you mean? What is the understanding with the word default? I wish Mr. Kamal Garg was here. We could ask him what is default and what is continuing default. In my opinion, if you have not filed by the time allowed by the Act, then the next day there is a default. And the default will continue till the statements, the necessary statements are filed with the registrar of companies. So it is the 10 days or 1 month or 2 months or 6 months of the case may be, that is the period of default. And for during that period, you cannot use any of the exemptions available to a private limited company as listed above. Otherwise, once it is filed, then the default is no longer there, and therefore the exemptions will apply again. This is my view as far as this is concerned. There are some advocates who say once a default has been committed, you are not eligible to avail it at all, which I don't think is the right thing to do, because it is only a default. A default is rectified the minute the filing is done, and therefore it should the exemptions and relaxations should come back to the company once the default is rectified. There is also an advisory given by the same notification in paragraph 2, and that is given to you in the next slide, which is here. They are saying, while complying with such exceptions, modifications, and adaptations as specified, the company should ensure that the interests of the shareholders are protected. That's what I meant by saying spirit of the law. You cannot, although an exemption has been given, you should see whether it is in compliance with the interests of the shareholders and then apply or take the benefit of exemption. For especially in those sections on administration, you cannot have a clause completely in variance with what the law states. And that is what it means by interest of the shareholder to be protected. Next slide, please. Okay. 1% company is a company which has only 1% of the member. A OPC shall have minimum 1 director. It can have more than 1 director, but it should have minimum 1 director. Member and the director can be the same person. Only a natural person can form who is an Indian citizen can form OPC. Resident in India is not necessarily a qualification. He can even be a non-resident. I'm sorry, I wanted to change that. That's why I highlighted it. I think Mrs. Nirmala Sitharaman in her later budget said even a non-resident Indian can open an OPC, and therefore they are all eligible. This is what a 1% company is. What are the exemptions available to the 1% company is listed in the next 2 slides. It's only just straight away exemptions given. And we have covered most of it. It is board meeting where minimum 2 meetings, rotation of auditor 132 is not applicable. Cash flow statement you did not furnish. IFCR will not be applicable. Next slide, please. Signing of annual report by a single director, board report. You don't have to go by rule 8 of the board report of the company account rules, which essentially talks about subsidiary performance of subsidiaries, associates, joint venture, conservation of energy, technology, absorption, foreign exchange earnings from go. All this will not apply to OPC in a small company. Instead, they will have to give their director's report as per Rule 8A. Thank you, my dear friends, for a very patient hearing. I know it is the weekend. Everybody wants to go out and have time, spend quality time with their family. But the time given was 3:30 to 5, and I think in fact, I've concluded much before time because Mr. Gar did eat into 10 minutes of my time. But I think all of you will be relieved that I did not take more than this, because I'm sure all of us want to go back home and spend time with our family. Thank you so much.
Thank you, sir. Thank you for the wonderful session. Now I invite CA Deepa Rao to render a vote of thanks.
On behalf of the Chengalpattu branch, I thank the speaker, CA Shri Ramesh Shah, for sharing knowledge and his views on exemptions to private limited companies and OPCs. Sir, it is a very highly motivating set of achievements that you've compiled over the years, be it academic, professional, or personal. Your baritone voice and command over the subject has really kept us enthralled and made us all very keen listeners. Thank you for informing us that the Act and the notification have to be read together, and also for presenting your paper together with the PNs and the section numbers therein. You've given us a very broad and overall view of the exemptions applicable, enabled us to understand the fine distinctions between certain sections and the interpretations therein. For example, private companies under section 268, under section 2, subclass 71, small and medium companies versus small companies, CARO applicability for small companies, etc. Your word of caution regarding compliance with acceptance of deposit rules while doing the audit of a private limited company and filing the ITR of the directors are very much appreciated, sir. You have also walked us through management, key personnel, administration, filing of resolutions, director appointments, and you've really enabled us to understand it through your experience as well, with inputs based on your experience. Thank you for sharing your knowledge, sir.
Thank you so much.
I really appreciate it. I'm sure we all do, actually. Finally, a very big thank you to the members of the CCM, RCM, our very own MC members, for having organized this kind of a knowledge fest. And this has only made us feel ki ye dil mange more. Thank you.
That's a good one.
Thank you, participants.
Thank you, sir. Thank you. Thank you.
Sir. Thank you. Thank you, Gita, ma'am.
Thank you. Thank you,
Thank you,
sir.
sir.
Thank you, Priya.
Thank you, Priya. That's a great job.
Ramesh, sir, good evening.
Good evening. Good evening.
How are you?
Good evening, sir. Kumar sir, good evening.
இல்ல முடிச்ச பிறகு தான் நான் குட் ஈவினிங் சொல்லிட்டு இருக்கேன்ல. Maybe the good night time.
இருந்துப்பீங்க தெரியும். Good sir.
இல்ல குட் நைட் சொல்லிட வேண்டியது. How are you?
Good sir. எல்லாம் உங்க தயவுல
Very
இருக்கேன்.
nice, very nice.
நல்லாவே இருக்கேன்.
எங்க தயவா? நான் இப்ப எல்லாரும் தயவுல இருக்கேன் நானே.
இல்ல அப்படிலாம் ஒண்ணும் இல்ல சார். எல்லாரும் எல்லா தயவுலயும் தான் இருக்கோம். It's community living. Living with the sick.
Yeah.
Good evening, Ramesh sir. Good.
நல்லா இருந்தது சார். Nice
Okay,
to see all of you after a long time.
Talk to you later.
Couldn't come for the thing, but
Yeah.
nice to see you all.
We will meet sometime.
Definitely, sir. We'll do that. Thank you, ma'am. Thank you, Geeta, ma'am. Thank you so much.
Thank you, sir. Thank
Full-ஆ
you so
இருந்தேன்.
much.
நான் 5 நாள் full-ஆ இருந்திருக்கேன்.
ஆமா சார்.
அதுக்கே உங்களுக்கு ஒரு
excellent sessions. ஆமா.
Excellent. 5 நாள் full-ஆ இருந்திருக்கேன்.
The corporate team headed by Geeta madam did a lot along with Priya.
Super.
Priya.
Yeah. Priya was you know, somebody also said constant follow-up with me. I think she kept on and on and on. Okay, sending messages, sending WhatsApp messages, and kept on and on. I think
Right person for the right job, sir.
Absolutely, absolutely. I think she was also very clear about what she wanted from the speakers and what instruction to be given to the speakers. And any request from the speaker was all immediately attended to. Thank you so much, Priya. Thank you. Thanks, Satya. Thanks, ma'am. Thank you so much.
Thank you.
Thank you. My
அடுத்த செக்ஷன் எப்பப்பா? அடுத்த செமினார் எப்போ?
அதுக்கு அப்புறம் சார்.
கொஞ்சம் ஒரு வாரம். ஏன்னா தேக்கடி இப்பதான் பண்ணல.
ஆமா சார். ஜஸ்ட் now completed தேக்கடி சார். 8th முடிஞ்சது. So the 10th ல இருந்து வந்துருச்சு சார்.
ரைட் பா. Thank you. Thanks, Satya.